Good morning, good afternoon, and good evening, everyone, and welcome to our Spring 2026 IPO Bootcamp. My name is Colin Mahan, and I'm a Director of High Growth Impact Entrepreneurs and Head of Sponsorships at the Nasdaq Entrepreneurial Center. And for those of you who may be new to the center, we're a nonprofit dedicated to expanding access, knowledge, and networks and mentorship to entrepreneurs who need to build and scale their companies. Today's session is designed specifically for founders building companies with significant growth ambitions. Whether you're raising capital, scaling go-to-market, entering new markets, or preparing your company for long-term scale and exit opportunities, this is for you. Before we dive in, I'm going to launch a few quick polls. We use this feedback to help guide the programs and resources we build for this global community of entrepreneurs. The first one, how are you feeling about your business? Are you optimistic? In survival mode? Let us know. Also, while you're answering these polls, feel free to drop in the chat where you're dialing in from today. It's always great to see the range of places our founders are coming from. We're also going to have live Q&A near the end of each panel, so feel free to submit those questions for us at any time using the Q&A feature at the bottom of your screen. All right, while these polls are running, let's see where you're joining us from. Iowa, Ohio, New Jersey, Florida. Love it. Los Angeles, welcome everybody. Amazing. London, Houston, great. Love to see it. Variety of time zones, Maryland, Brunswick, great. All right, well, while these polls are running, I'd like to briefly recognize the partners who make this work possible. Programs we provide at the Nasdaq Center are supported by organizations including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Dream Foundation, KKR, and BPM. Their support helps us expand access to knowledge for entrepreneurs around the world, and we're grateful for their partnership. Now, let's get started. And without any further delay, please join me in giving a warm welcome to our first special guest who's going to be providing our market update. We've got Howard Lanzer, Managing Director at KPMG. Howard, welcome.
Hi, how are you?
Doing great. I'm looking forward to learning more.
All right, well, I'll share my screen here and we'll get moving.
Over to you. Thanks.
Well, good morning and afternoon, everyone. Thanks for having me at the IPO Bootcamp. I'm Howard Lancer with KPM Corporate Finance, and I lead our capital markets advisory practice, which is located within our investment bank. Today, I'll give you a relatively quick overview and founder-friendly view of what's happening in the IPO market, as well as the M&A and capital markets, and more importantly, what that means for you as you build towards an IPO. So when I finish today, I hope you'll have a practical mental model for whether the public markets are open for you and your kind of story, what investors are underwriting today, and what you need to do over the next, call it 6 to 18 months to improve your story, whether you ultimately go IPO, whether you sell your business, or whether you raise capital privately. So I think the headline here that we've been tracking is that the IPO window is open, but I think the key caveat here is that it's selective. So the market is funding quality, durable growth, credible margin paths, defensible moats, operational readiness. Those are the key themes that we're seeing in the market today. But what we're not seeing and what's not working is kind of those story-only equity, where you've got a big TAM, big market, exciting vision, but limited proof in the numbers. So as I go through these slides, I'll try to keep translating what we're seeing kind of in the bar charts and the line graphs here into actionable language. So what gets rewarded in the market, what gets punished, and specifically what you can control. So as I'll flip over to our first slide here, what I always try to do is digest valuation through the lens of the M&A market. So what's happening in the M&A markets and how does that translate to valuations into the IPO market? So just like we're seeing in the equity markets, the M&A recovery remains selective, it's active. Big cap deals are dominating the market. We're seeing a lot of portfolio shuffling where large corporates are selling certain assets. And we're also seeing, of course, AI infrastructure is really dominating the M&A headlines. And so I think when you look at the market in general, kind of taking a step back about the macro risk, I think if you would have told me at the beginning of the year that we'd have a war in the Middle East, gas over $100, Strait of Hormuz closed, and that the Dow would be in the Nasdaq and the S&P 500 would be setting records, I would have still told you were crazy. This is one of them. I would characterize it as a very unique, almost surreal market right now, where we have all of these different factors that have historically closed markets, whether they've been equity markets or debt markets or M&A markets. None of those markets have closed. They've remained open but selective, but they're chugging along, which is unusual given all those factors, major factors that usually derail these types of markets. And really what it comes around is trying to understand certainty. Markets like certainty. Anytime there's uncertainty, it's hard to do valuation. So we think about geopolitics and execution risk. We've already had the issue here of COVID. We've got supply chains issues coming up here in the Straits. There could be customer concentration, cyber issues. The market is spending way more time pressure testing downside scenarios. So the standard for diligence is much, much higher in this environment. So the risk in your story, the way you present it, needs to be as crisp as possible, and it needs to be as crisp as your growth story. So you have to have a set of proof points on your growth story, but also a set of mitigants on your risks, and anticipate what those risks are from an investor perspective, and have answers and have mitigants of how you're addressing that risk. Interest rates, we can never get away from that. Even though we saw some earlier cuts, I think the market now is perhaps even anticipating rate increases, with inflation now trickling through the economy because of what's happened in the Middle East. So what that means is higher base rates mean higher discount rates, which means the market is less patient with more of the long-dated payoffs that we often see in IPO stories. So the investors are really focused on nearer-term visibility into your cash flows and a believable path to stronger margins. And then volatility always slows down decision-making. We see the boards and public investors don't necessarily need perfect certainty, but they know that you specifically can operate through this uncertainty. And that's why we keep saying the market is selectively open, and you've got to really be able to prove how you can operate in this level of uncertainty. And of course, the big theme here, as we touched on the M&A market, it's still here in the equity markets, is AI infrastructure. We're seeing extraordinary strategic pressure around compute, connectivity, data centers, and power. So if your business is directly in that stack and touches somewhere in there, you're going to benefit from it. The investors completely understand that tailwind very, very quickly. But if you're not, you need to be explicit to why your growth is still durable, because all of the oxygen in the room seems to be going into this AI infrastructure. And it's very difficult sometimes to get investor attention on things that are outside of that stack. So as we look at the IPO markets in general and kind of juxtapose that against the M&A market, the IPO window, it's open, right? And the activity has improved materially through the trough year. So we're seeing more deals priced and more companies file, which is the good news. But again, we're going to keep coming back to that word selectivity. Investors are doing fewer benefit of the doubt deals. So the market is, I'd say, relatively open versus the trough, but it's not ready to forgive complicated or messy stories, right? So we're not talking necessarily about one metric that's going to make or break your IPO. It's more of your confidence in your ability to generate repeatable revenue, confident in your unit economics and your margin trajectory, confidence in your ability to report results cleanly and consistently as a public company. That's the key, right? So you don't have to have all of your ducks in a row, everything down to certainty, but you have to have confidence, and the way you express that confidence is being able to tell a cohesive and coherent story. And so what we're seeing right now in the market, in terms of green flags, we kind of look at the green flags and the red flags. So what is making a successful IPO candidate today? Number one, as we touched on, revenue visibility. So what do we mean by that? Recurring revenue, obviously, is the best kind of revenue. Long-term contracts help, where you've got solid, uncancelable contracts that you can essentially underwrite against those. Strong customer retention, predictable cohorts, right? But if you're not having that type of recurring revenue, then being able to measure backlog, renewals, embedded distribution, anything that creates a sense of repeatability will help your revenue story. Then margin trajectory. So you don't need to be fully profitable today, but you do need the credible, explainable path of what is driving your gross margin, most important here, and then what drives your operating leverage, and then how do you turn that into cash? All right. So again, it doesn't need to be today, but you need to be able to tell that story that gets investors to, okay, sustainable growth margins, they know how to operate the business, and they know how to make cash. Then we also talk about KPI discipline. And so we always recommend is picking kind of the 3 to 5 KPIs that you can live with for years. Define them, keep them consistent, and make sure they tie to value creations. The markets do not like to see KPI drift because it fundamentally undermines the trust. And so as you build out your models and your dashboards, we always recommend to our clients, have that dashboard. You've got the 3 or 4 to 5 key KPIs that you've been tracking over time. You're monitoring them. You can understand why there's blips in these different KPIs, what you have done to address that, and where you're going to go going forward, because those KPIs are going to drive your growth projections, and ultimately is what the investors are going to be focused on. And so when we see on the red flags, things that tend to get punished in the market is those inconsistent KPI definitions or failure to hit those. Heavy adjustments, like a lot of EBITDA add backs that are kind of under or obscuring the underlying economics. And that these narratives that require perfect macro conditions or perfect execution to work. Those are kind of the red flags that we see where investors just can't get their arms around it and kind of move on to different investment opportunities. So obviously what we're seeing now here in terms of the current market and some of the themes that we're seeing, AI and compute adjacent stories are dominating it. But we've also seen a lot of the energy and power link narratives, especially for digital infrastructure. And then we're also seeing national security, obviously being a big issue here, or a big investor focus as well. But I think from our perspective, while those are dominating, I wouldn't necessarily say that there's no appetite for other exciting growth stories. Those tend to, again, suck up all the oxygen in the room. All the headlines seem to be pointing that direction, but there is opportunity, and we are seeing interest across sectors, healthcare, industrial, certain areas of consumer. Those are still attractive investment opportunities for investors. Now, looking at the financing conditions, as we talked about before, higher rates definitely drive valuation, right? Because investors are demanding more proof per dollar valuation. Because what it ends up doing is that you're looking at the cash flows in the future. A higher discount rate means the value of your firm today is fundamentally going to be lower, right? So what it ends up doing is that without that hyper growth story, it compresses really the set of companies that can price in an IPO at attractive terms, right? And it also really increases the penalty for missing guidance once you're public. So one of the dangers that we see is that we've got companies that go public, they have over-optimistic projections, the macroeconomics start working against them in terms of just the market environment, and then interest rates as well. And so if you miss, the penalty becomes even more severe because the discount rates are even higher. So a miss kind of compounds itself back to today in terms of where your valuation is going to be. Now, interestingly, on the private capital side, there's been some news stories about what's happening in private credit. I spent a lot of time focusing on that market as well. Despite what you're hearing, there is meaningful dry powder on the private credit side. But again, that deployment is disciplined. And it's been one of the gating factors since the exits haven't been as frequent, where private equity firms tend to hold on to these portfolio companies because the valuations have gone down. What we're seeing in private credit is that they've been forced to extend a lot of their loans out there. So although is a lot of dry powder, we're not seeing a lot of supply coming in from where the traditional supply channels like private equity. They've been holding on to these assets longer. But I would say that as you're thinking about financing your firm, as you're thinking about growing, this market is still there. It is still available. They're hungry to deploy capital for the right opportunities. Now let's kind of take a step back on the sector multiples here. We look at the M&A multiples, again, to give us a sense of what's happening in the public markets in general. So what we've been seeing is the market has been consistently paying for scalable growth. Again, technology, AI enablement, healthcare IT, kind of other capital light models. So these sectors are still commanding strong valuations. And when we see valuation is very much anchored to earnings quality and cash flow visibility, right? So this is not the era of growth at any price. It's earnings quality and cash flow visibility, right? But whether you're pre-profit or if you're profitable, where investors want to see a very defined, very solid bridge from growth to durable cash flow generation. That is the key, right? We literally on pages when we're out marketing deals, we have a bridge page where we literally show the different components on a bar chart that builds up the EBITDA growth and the cash flow conversion over the projection period so the investor can specifically see each component of what's driving growth and cash. Now, we always take a look in the M&A market here, and again, giving us insights to the IPO market is that the M&A, tape is showing us that big deals are dominating the market right now. Okay, so, even if your IPO is plan A, big M&A affects your comps, your strategic optionality, and the overall investor sentiment. So these big deals dominate the headlines, but nonetheless, they give you a sense of the risk appetite in the market. So the billion-dollar plus deal environment really shows us where strategic value is concentrating. Again, A&I infrastructure, platform scale, portfolio transformation, and assets that improve resilience. So for founders, the practical takeaway of this slide is that if you define your strategic scarcity, that is going to be critical. If you don't IPO, why would someone buy you and why? Right? So building that answer strengthens your IPO story because it clarifies your moat and your role in that specific ecosystem. So again, always prepare as if you're going to sell your business to someone else, because that will allow you to identify some areas where you need some of the red flag areas where you need to start developing mitigants. It also allows you kind of to punch holes in your growth stories, punch holes in your KPIs, and make sure you're solid, because telling your story to a potential buyer always strengthens your ability to communicate that to the broader IPO market. And as we look at exits too as well, and kind of dovetailing off what I just said, from a sponsor perspective, we track, are they IPOing or are they selling? And so usually, particularly if you haven't raised institutional capital from private equity, I'll take a step back and kind of explain their mindset. So usually they're looking for a 3 to 5 year hold time. So they invest the money. They want to see some type of monetization within 3 to 5 years, where they're getting their money back plus a healthy return. As you look at the chart at the bottom of this page, what we've seen is kind of a lengthening of these hold times because of market conditions, where the M&A market post-COVID and after the big explosion after post-COVID of M&A deals, things as rates went up, M&A deal volume tapered down, and so valuations went down. So private equity firms are trying to hold on to these businesses longer, waiting for the deal market to improve. So this graph's a little bit skewed in terms of current conditions, but the way to think about it is usually a 3 to 5 year hold time. Sponsors tend to prefer the M&A route, but they also, particularly if you've got an attractive growth story, will look at the IPO route, because the M&A route pays you on a trailing perspective, right? The M&A market says, I'll pay you for what you've done. I'll take a look at your growth story, but I'm going to buy the business and I'm going to be responsible in taking on that risk for future execution. Whereas The IPO market is valuing you forward-looking, right? So they're paying you when they buy your shares in an IPO for what you're going to be doing in the future, right? So they're looking at your future growth. And when you tell your growth story, that's why it's incredibly important that you're able to execute against that. So you tend to get slightly higher multiples in the IPO market, but you don't get instant liquidity. Usually when you do your IPO, you're selling primary shares, and it takes you a series of follow-on offerings to continue on your monetization path. So M&A, get the cash day one, usually. There could be some earnouts and other things, but you're getting your monetizing today is the way to think about that. So the valuations historically have been at a discount to what you're seeing in the IPO market initially when you go public. But from an IPO perspective, it takes you several years before you can fully exit as a private equity owner. That's why you see a lot of private equity owners tend to favor the M&A route as an exit alternative. So I know I'm running out of time here, so I'll wrap it up with some actions that you can take now and things to be thinking about in a way to really interpret where the market is today. So first, as we talked about, operationalize your story into KPIs. This is very important. So choose a small set, lock in those definitions, and build the internal discipline around them. This is going to be whether you're selling your business, you're going to go public. The KPI story is paramount. Okay. Second, build a credible margin and cash flow pathway. Build that bridge. Be able to explain the operational levers that drive your gross margin and then your operating levers. Because fundamentally, you have to have strong growth margins. You have got to be able to defend your moat, and you actually have to operate your business. Can you do it lean? Are you even if you're not directly tied into AI, are there ways to leverage AI to improve the operations, the operating profit of your firm? And then also we'd say finally to run a dual track mindset, right? So what does that mean? So even if your IPO is the goal, understand your strategic alternatives, understand your financing options, because there could be multiple steps before you actually go public. There may be an attractive acquisition opportunity that will double the size of your business prior to going public. You may want to investigate what's called a dividend recap, where if you do have cash flow and you are operating profitably, you could borrow money from the market, pay yourself a dividend, and use the proceeds of the IPO to help pay down that leverage. And also, as we talked about, always be selling, right? Always be thinking about how would you explain this to an investor, whether you're selling yourself to an M&A buyer or if you're going public. How would you explain what is happening right now in the market and how that's impacting your KPIs? Okay. So the bottom line of all this is that the window is open for quality and preparation is key. So with that, I can wrap it up and happy to take any questions.
Amazing. Thank you so much, Howard. And for a couple cycles on these boot camps, cautious optimism was real. But I think based on what you just said, it's actually here. So I love it. If you wanted to stop sharing your screen so we can see your smiling face, we've got a couple questions from the audience. Let's see, as you're keying that up. From your experiences, do you think multiples for hot sectors, defense and space may already be too elevated?
Yeah, that's a $64,000 question, right? So it's one of the
17-day question.
Yes, it is. It is. And I think really it's hard to pick peaks, right? And I think if I could pick peaks and if I could market time, I definitely would be doing this call on the beach somewhere in the Caribbean and not in Chicago, even though the weather's getting nicer here. I'd say, what's really interesting and what people are really trying to get their arms around is AI, because it's going to impact space. I mean, we've obviously have SpaceX coming down the pike. There's been a lot of interesting things to read about it in terms of its cash flow generation capability, its growth rate. So that's obviously top market. It's hard to say in general. I think defense and aerospace seem to be a market that people are going to think that, well, there's unfortunately going to be revenue stability because the world is so unstable, right? That from a defense perspective, especially after the war here, there's going to have to be replenishment of the ammunition. So hard to say if it's at the peak. It's really going to come down to believable growth and all those factors we just talked about. Can you drive sustainable growth? and has the market kind of overvalued your growth? That's what it always comes down to.
Awesome. And nobody has a crystal ball, but looking at the end of 26 and 27, do you have any predictions on if we're going to see another 22, 23?
I think we've been waiting for quite some time to get the M&A engines roaring again. I don't think they're going to be roaring. I think they're going to be solid, though. I think it's going to be a very good year. Once we get through the uncertainty of Iran, and hopefully, knock on wood, that's soon. The conditions overall are good. We're going to have to deal with inflation. That's definitely going to be here. The elevated gas prices and diesel and the issues coming out, and don't forget fertilizer, helium, everything else that was coming out of there. There are definitely going to be some supply chain challenges and some pricing challenges ahead of us. But I think people are very excited about AI. It is absolutely kind of counterbalancing the increase in inflation as the productivity we're getting out of it. So I think it's going to be a pretty interesting year. Again, I don't think it's going to be going back to the aerospace analogy, a rocket ship year, but it'll be a nice sports car. How about that? Instead of a rocket ship, I think we'll have a good year. I think the credit markets are wide open. We're seeing the leverage loan, high yield, term loan B, just any good deal that comes up, it's getting snatched up. We've got, and also too, we didn't touch on, we have some of the tightest spreads in lending that we have seen. In terms of the base rates are up, but the spreads are historically compressed. So, with a floating rate note, if the base rate comes down and those spreads are tight, you're going to see earnings acceleration just from a financing perspective as those interest rates come down on a floating rate basis.
Awesome. Well, on that amazing rocket ship note, I'm still a fan of a fast car though.
Yeah, we'll see. Hopefully we'll get that.
Thank you so much, Howard, for sharing that market update. Really appreciate you joining us today to share some of those insights.
Right. Thanks for your time.
Alrighty. Well, everyone, we have an upcoming panel on IPO readiness and legal considerations. So please join me in welcoming our panelists. We've got Drew Del Mato, who's a CFO at Netscope. We've got John Michael Kretz, who's a managing director at KPMG. Austin March, partner at Wilson Sonsini. And Jan D'Alessandro, Chief Legal and Philanthropy Officer at Pledge 1%. Welcome, everybody.
Thank you.
I'm looking forward to this. And Jan, over to you.
All right. Thank you, Colin. Thanks, everyone. So my name is Jan D'Alessandro. I'm the Chief Legal and Philanthropy Officer for Pledge 1%, which is a nonprofit started by Mark Benioff and Scott Fakar. We support companies in building social impact programs. I'm particularly focused on helping them set aside equity at all different stages, from early stage all the way up to immediately pre-IPO. Happy to talk about that if anyone's interested later on. So now I'm going to ask the panelists to please introduce themselves quickly with your role and a single piece of IPO readiness work that you wish every company started 12 months earlier than they actually did. So let's go ahead and start with Byron. Okay, let's start with John Michael.
All right. Hey, everyone. John Michael Kretz. I'm based in Dallas, Texas. I'm in our accounting advisory services practice at KPMG. I lead cross-functional teams that help companies transform their organization from current state to future public ready state across accounting, reporting, tax, corporate governance, internal controls, et cetera. I lead our construction and engineering subsector, but I've done that several dozen times for companies in different industries of different size and complexity. And so I'm happy to be with you today. As far as the advice about what companies should start earlier, I think it sounds simple, but I wish companies would begin their journey and plan 12 months earlier, or maybe even earlier than that. Often we meet with companies who have goals to sprint to an IPO to meet market windows, and we are here for that. But You can stage this journey over a longer period and make healthy changes to your organization now that can benefit you regardless of your outcome, and hopefully make the 6 to 9 months that lead up to your effectiveness date a bit more manageable.
That's great. Thank you, John Michael. Austin?
Hey, good morning or afternoon, wherever you're sitting. My name is Austin March. I'm a corporate and securities partner at Wilson Sonsini. I'm based in Austin, Texas. My practice is primarily focused on representing late-stage private and public companies, and an important part of my practice is representing companies through the IPO process. So I look forward to talking with everyone today about my experiences and what we're seeing in the market. One piece of advice that I would give is, similar to John Michael's, that you really need to start this process early and to be thoughtful about it in advance of, the time that you meet with the banker and the banker says, hey, you got a market window, now's the time to seize the day. And that relates to making sure that your board and your management team is the right you have the right folks in place so that whenever your number is called, you don't have to go out and start a 3-month search that can totally derail your timeline.
Great. Thank you, Austin. All right, Drew?
Yeah, thank you. So Drew Delmato, I'm Chief Financial Officer for Netscope. Netscope, we IPO'd last September, so I think that's why I'm here today to tell you a little bit about that journey and process. My background, I was a CPA a long time ago at KPMG, and 25 plus years in technology, serial CFO. I left Symantec as the acting CFO, was the CFO of Fortinet, Citrix, and joined Netscope given the awesome opportunity. Netscope is a AI and cloud security company, doing very well, and so again we started our journey in advance of a year. We always thought we'd have a good opportunity. The markets were obviously challenging, for quite a period post-COVID, but they did open up last year for a period of time. I think if anything, the one thing to do, and I think we did a great job, was engaging with investors early, and that's because you want them to be comfortable with the story, comfortable with the team. You want to be comfortable with the investor base as well, right? Getting to know them, how they interact with you, how they provide feedback. Are they absorbing the story? Do they really feel like they're on board? Because, for us, it was very important to have long-term investors. Think about the security, AI space, cloud space. It's a long-term journey. It's going to be there for a while. And so that's how we thought about it. And I would encourage everybody to think about it like that as well.
All right, that's fantastic. Thank you, guys. What a great panel. Thank you, Colin, for putting together such an esteemed group here. So let's get started. To frame our time together, IPO readiness is a term that gets used a lot. Tell us, panelists, what does it actually mean to you? And how do you tell the difference between a company that's truly ready and one that's just told that it is? So if anyone has any thoughts on that, please jump in.
I'm happy to start, and others can weigh in if that's. So I think if a company's hearing that they are IPO ready and they haven't gone through an assessment, which we'll talk about, to determine kind of what they need to accomplish to become IPO ready, it's likely based on financial performance and or equity story alone. So in other words, they have strong financial performance or growth over several years, or they have a compelling story to tell around their company. Howard talked about that a bit. Both of these are really important in the long run. But what I think IPO ready actually means is that your company is ready to operate or is already operating as a public company. And there are significant differences between the expectations of a private company and public companies. So just for example, you need to be able to consistently produce reliable SEC compliant financial statements and disclosures. You have to be able to go through a PCAOB audit timely enough to meet 10K deadlines or 10 other reporting requirements. You have to have the right governance and controls in place and operating. You have to be able to reliably forecast your financial performance. And so you should have a sustained operating model around all of these. And until your company has these structures in place, I'd argue you are not really IPO ready.
Look, I would just come on to that. I think it's, again, I'm going to go back to, you're going to have this engagement. There's a engagement period with the market. You're going to tell them your story. You want to have a crisp story, and you want to be executing against that. And that's really the financial profile. You need a team in place that can execute on the things that John Michael was just discussing, right? So you need people who understand how to put the controls, the governance in place, and all of those things. Uh, but again, it's a long-term relationship that you're developing. So you want to be crisp on your story. You want the story to resonate and echo throughout the ecosystem, if you will, because investors are going to call partners, they're going to call your customers, they're going to call probably your employees and certainly your ex-employees to really see what's going on and what the true story is. And so having everything aligned in a crisp story, your KPIs in place and executing against it, I think those are the key things. And obviously, and I would mention, John Michael mentioned the PCAOB audit. We did that early and did it for a reason. And I think the world's a little bit different, but if you go back 15, 20 years, a lot of companies would get to the altar on IPO and then they'd find out something was wrong internally in the financial statements. And then of course they shoot the CFO and the accounting people and delay it 6 months. In fact, there was an IPO 2 years ago that was supposed to go in September. And lo and behold, at the last minute, something came up that actually delayed the offering 7 or 8 months. And I think some people had a very challenging 6 or 7 months, if you will. So, get that stuff out ahead of time, get it done. But again, be executing on a crisp story is key.
No, that's great.
Yeah, and just to add to that, echo all those sentiments. I think from my perspective, when I think about an IPO ready company, I'm not thinking about their ability to complete an IPO. I think about their ability to be successful as a public company. And it's not just about, the snapshot of can we pitch the investors on, investing in this specific offering. It's making sure that, to Drew's point, that you have your story and you continue to execute on it post-closing, and you know what you're going to hit each quarter and you actually deliver against what you're giving in guidance. So making sure that you are going to be successful and hitting the ground running as an entire enterprise post-closing, that's what I think about when I think about a public company ready.
Yeah, that's good. So John Michael, when you run a readiness diagnostic, what are you actually assessing? Paint a picture of what a typical pre-IPO company looks like 18 months out versus 6 months out.
Yeah, good question. So a diagnostic, IPO diagnostic, or what we call an assessment, compares the company's current operational or administrative or back office state, their operational state, with that of a public company. So your desired future state. And as Austin mentioned, we would measure that success as a public company. That covers the entire organization: accounting, reporting, FP&A, tax, governance, internal controls. I'm missing some: HR, compensation, investor relations, the whole gamut. The differences between current and future state are collected, you prioritize them alongside management, and you develop a plan to address all of those differences. Now, referring back to the previous question, we're assessing overall organizational IPO readiness, as opposed to judging that based on financial performance or equity story alone. To the second part of your question about 18 months out versus 6 months. Speaking in generalities, because every circumstance is different, a company that is 18 months out from IPO likely has no real IPO plan. Maybe they have general timing, but they don't probably have any organization around how to achieve that timing. They probably have pretty fragmented systems, or multiple ERPs, even and manual processes around those ERPs. They may have limited or non-existent SEC or technical accounting depth. informal controls, long close cycles. I think you're getting the idea. On the close cycle, often we see 2 to 3 weeks, 18 months out, maybe even more. And those are just structural issues that come to mind. That's not to mention there's no SEC disclosures present in their financial statements, which is normal. A typical IPO run takes somewhere between 9 to 12 months. So a company that's 6 months out from IPO likely has, or is doing, or should be anyway, probably has a detailed plan in place and is executing against that plan. They have brought in SEC or technical accounting guidance, whether that be hired in-house or outsourced. And I'll just say of note, if you're outsourcing that should be temporary. Everything else is probably in process 6 months away. You're going to be undergoing a lot of changes at that time between that, within that 9 to 12 month window, with multiple work streams in process at all times. So it's really, really important that you have the right service providers to support you, or in-house professionals to support you through that period.
That's great. Thank you. And from a governance, compliance, legal aspect, Austin, is there anything you might add?
So the 18-month out window, there's a lot of kind of getting organized internally. You're thinking about collecting the information you're gonna have to provide from a diligence perspective. You're thinking it's more on the accounting side, I would say, to John Michael's point, is getting your internal controls up to snuff and thinking about getting your PCAOB audit, because those are going to be the long poles in the tent. The disclosure is going to come together more in the 6-month period before you want to go public, because it's hard to disclose and describe a company that has not gone through the process of thinking about the message it wants to give. And so that period from 18 months to 6 months, that's when you're refining your messaging, you're getting the right people in place, you're consolidating all the diligence materials, you're thinking about the sensitive areas of disclosure, which I think we're going to talk about a little bit later. And then once you've kind of gotten your arms around all those issues, that's when you start putting pen to paper on actually describing the company in a narrative form that's going to go in the S1.
Makes sense. Thank you. Drew, when you started preparing for your IPO in earnest, what surprised you most about the gap between where the company was and where it needed to be? And what do you wish somebody told you earlier?
What do I wish somebody told me earlier? Look, I would say I feel like we were pretty well prepared. And what I would say is it's critical to get the right people in place. And I think certainly for my role, right, as a CFO, there's really 3 elements that I think about. When I look back, what I think we did right was really thinking about, one, communications, right? How do we control our narrative? Think of it this way: we're in a competitive space. Our competitors are very happy to define our narrative for us, right? And so we want to be in front of that, defining our narrative to the market and supporting that internally. And that leads to the next thing, really, where you have to have finance in place, right? So I think we mentioned forecasting, but also the KPIs, the metrics, the cadence of operating the business in place. And then finally, the accounting piece. And again, these things are a cocktail, if you will, right? They sort of blend together. And so that the company, with the right communication, the right operational cadence within finance, the right accounting and controls in place, the company's ready. The story's there, everything's aligned to support that story, which is your vision and strategy ultimately. And so those are the things that really drive the business. And so when I look back, I think the things we did right were getting the right people in place. All of them had IPO experience. I looked at that as critical, because you don't want it to be a learning experience, which it can be. And I think that's why the question was phrased that way. So, and so, maybe just sort of the foresight, through experience, to know that having people with experience, making it about Netscope, not about individuals or individuals within the company was critical. Communications is key to that, because you got to bring everybody in the company along with you, along with the investor base.
Yeah, no, that's great. So drilling down a little bit more into the finance organization, John Michael, let's talk about like the people, the systems, the processes. What roles need to be in the seats 12 months before the filing? Which ones can wait till a little bit closer to actually go out, or maybe even after the IPO?
Sure. Yeah. And Drew touched on this a bit. There are a few personnel requirements for an organization, but most of that centers around the board of directors, the audit committee, the C-suite. So none of those, though, would expressly require that you have any specific roles in place 12 months prior to your effective date. That said, the SEC, stock exchanges, and the investor public will expect you to operate as a public company immediately in many regards. So I think best practice would suggest, as Drew hinted, that at minimum your finance function be really well established as early as possible in your IPO journey. So maybe not 12 months exactly, but we'll say 9 to 18 months pre-filing. Granted, every company is different, but I think your CAO, CFO, controller for sure are critical. Another that comes to mind, whether it's internal or outsourced, is SEC counsel, because they'll have a lot of guidance through this process. Maybe SEC reporting, though that could potentially wait a little bit later in the process. As I think Austin said, disclosures are really resolved roughly 6 months before you go public. You should have plans for other functions. So you're asking about systems, processes, people, and what positions or roles should be in place. I think investor relations, internal audit, a lot of those are outsourced. So as long as you have a plan for either bringing them in-house or outsourcing that function, then you should be good 12 months out. The reality is that a lot of these roles will have a very long lead time, and they will also take time to get familiar enough with the company to kind of operate optimally, if you will. And these roles can be a source of IPO delay if your team isn't able to produce an S1 timely or financial statements timely, or they aren't ready for kind of those recurring reporting requirements. Drew, you mentioned a delayed IPO. That's pretty common that there are issues surfaced in an audit. And so if you can get your team in place early in that process and try to get ahead of all of those audit findings, then that's certainly best practice.
Yeah,
so
and just to add to that, a point that Drew made earlier, which I think is important to emphasize, the investor community, you will be meeting with them continually. And so you want to have the right people in place that they know that they've gotten a relationship with, that they can trust, and you can execute against the business plan that you're telling them about over 6, 12, 18 months, so that when it's time to actually, commit sales as part of the IPO process, they know the business, they have seen you execute against it. And so you can't be in a position where you're bringing in a CFO that's kind of investor focused right before the process starts. It's best to have that team in place in advance so that you're building those relationships with investors, with the banking community in advance of the time that you actually want to go out and start talking to investors.
Yeah, that leads really nicely to the next question for Drew, is about the hiring sequence. What was the order of operations on your finance and IR team build? What did it cost? I think sounds like you guys did everything right, but did you overinvest in anything or underinvest? Is there anything, in the hiring sequence that you might have done differently?
Well, I don't know that we did everything right, but
yeah, you did.
we did a lot right. And I don't think, I think just to, sort of qualify that a bit, I felt like we mitigated the risks that are very common. And I think we alluded to a few of those. And what I would say is there were no surprises. Maybe that's the way to think about it. I'm sure there were things, wrinkles we could iron out better. Look, at the end of the day, this is a big project, right? You have to run it like a project, just like any project, like it's like an ERP anything, right? And it really involves everybody in the company. And I always thought, I told my team, you're leading this, for all these investors who got us to where we are today, who supplied the capital, who put their jobs on the line for us, all the employees. This is about all of this, and it's super important that we execute at a high level. Back to your question, again, I'm going to say the three key things I hired, are communications/IR. We have to tell the story internally and externally, and we need to engage with our investors, right? This, at the end of the day, we're looking for long-term investors. We were certainly looking for long-term investors. We want to be here for the long term, right? And, we wanted that operational cadence in place. And so we had a finance, but, hired senior finance person. Somebody with some banking experience, I think, was very helpful. Understanding how the market works, understanding how to build the investor base, some help on the pricing, just thinking about how investors might think and have somebody internally that could help us with that. And then also just finally, a chief accounting officer, controller, whatever you want to call it, who has IPO experience. And that's how we thought about it. Again, this whole process is about recruiting a very long-term relationship. It's similar to a marriage. There's going to be an engagement period. The last thing you want is surprises at the end, when you're at the altar, you want this to go smoothly. You want to be able to have a partnership with your investors that's over the long term. And so, getting everything right up front is critical. Having the right people in place that can execute that is critical.
Yeah. Okay, that's great. John Michael, so quarterly and monthly close discipline. What does public company ready actually look like? And how do you stress test it before the SEC and the street who are watching? Before before the SEC and the street are actually watching.
Sure. Yeah, I think got it. Yeah, often we find that private companies aren't doing a monthly or even quarterly close, or they may be doing it informally, but it's not a full close. So I think the just baseline expectation is that you are doing a proper quarterly close. As of now, anyway, quarters are to be reported to the public once you are on a public exchange. The SEC has a proposal currently open for public comment that would allow companies to elect half-year reporting instead of quarterly reporting. So that's in process. But if you aren't doing a quarterly close, you'll want to think through any annual adjustments that are made currently that should be made more often. So things like tax, impairment, mark-to-market adjustments come to mind as common culprits. This is very common. We call it a quarterization process, where we look for out-of-period adjustments and move them to the right quarters. Again, a period close should take 7 to 10 business days. I referred to the 2 to 3 weeks earlier, so that should be shrunk 7 to 10 business days, and you should generally build that around a quarter timing, because that is the shortest that's required of a public company. So 40 to 45 days total to the public, depending on your filer status. So you may already have a quick close. Maybe you're saying, oh, well, we're 7 to 10 business days already, so we're good. Maybe I would consider additional requirements of a public company, both during and after close, that may force you to accelerate close overall. So think about additional SEC disclosure requirements, or I guess in reality, any disclosure requirements, since many private companies only report financial statements at the quarters. Also, you'll be required to undertake additional reviews by leadership, by the board, and there'll be additional rigor around that review. So both of those things can add to your reporting cycle. So it's important to know how your close cycle fits into that. Monthly close, as you asked about, is really a standard practice to manage the business effectively, but it's often less rigorous than quarterly or annually, of course, since it's not reported publicly. To stress test that process, I would suggest, or we suggest, that you implement those kind of enhanced close and reporting processes, and then do dry runs at period ends leading up to your IPO. So include in that dry run a full close process, your earnings release mock-up, do a mock earnings call, draft a 10Q or a 10K. It gives your team a chance to get used to that process. It also allows you to work out any kinks in that process, and it's definitely best to iron out those issues within confidential filings when the public doesn't really have visibility into your timelines or other factors in those filings. And you can do that at any period end date, but I think it's most useful if you can align that with periods that you are reporting within your S1. As you update your S1, you can use that as an opportunity to do those dry runs.
So that's leads really nicely to the next question. So Drew, how far in advance did you start doing the dry runs, and did you find them to be particularly helpful?
We probably started. Look, again, I'm going to go back. We put an operational cadence in place that was going to survive. We ran the company like a public company for a couple of years at least. I think one of the reasons is to ensure that all the people are thinking process. I think in newer companies tend to be functionally driven. And so in a public company, there has to be some level of, there has to be some process and policies that have to be in place. And you want to get those in place early because, telling people you're sort of shifting things internally is going to be ugly, 6 months before the IPO. So you really want those things in place early. And that cadence and hygiene, if you want to call it, is important to have in place, I think, for the long term. And so, that's what we did. You hire professionals from the start, and expect everybody to, align to that, and then they're comfortable with it. Again, as Austin said, when you're public, you don't want to change things when you're public, right? And you don't want to change things leading up. You're building this relationship, right? And the last thing you want to do is undermine that credibility externally or internally. And internally means having that consistent process in place, not changing things just because you're going public. And then externally, once you're there, all of those things are just part of your DNA.
Yeah, makes sense. So Austin, here's a question for you about, economics of, founders and employees. As you're getting ready for the IPO, and how do you advise your clients to think about lockups, secondary sales? What should founders be thinking about, well in advance of when they start talking to the bankers?
Yeah, so I think kind of level setting, a lockup is the agreement by which the stockholders of the company will agree to be blocked from transacting in the securities for some period of time after the closing of the IPO. And there's a similar provision that applies to the company. It's commonly called a clear market provision, where the company can't go out and issue new shares for capital raising purposes for a period of time post-IPO. It is common practice that those periods both are 180 days. And for the lockups, that generally applies to all or substantially all of the existing stockholders. And so as you're working through your investment documents or your option grants or any other equity issuance documentation that you have as a private company, you want to make sure that those documents reflect the fact that they are going to agree to enter into a lockup that aligns with all the other stockholders in connection with the IPO. In the lockup periods, even though they're generally 180 days, there is some flexibility that goes into that. You can have tiered or staggered lockup releases where, a third over 60, 120, 180 days, so that it's a little more even spread as opposed to just a stark cliff when the lockup expires. You can have lockups expirations that are tied to the achievement of certain trading prices. So you price at $20 and you get to $30, maybe the lockup falls away at that point. And so there is some negotiation, but generally in a more challenging IPO market, companies just say, I want to take off any sort of friction that comes with the lockup, and they'll say, I just want to do the 180 days because that's what investors are used to. So from a blocking and tackling today, it's just important that everybody who receives equity enters into an agreement that says they will agree to be locked up at the time of the IPO. And similarly for secondary sales, those are in an IPO, there's what's called primary and secondary sales. Primary sales are sales by the company to raise capital for the company. Secondary sales are sales by existing stockholders of their shares to the market. And so the proceeds from secondary sales go to whoever's selling their shares. Generally speaking, IPOs are 100% primary. If the company doesn't have significant capital raising requirements or cash flow positive, they may say we want to have some people take some money off the table, whether that's management, whether that's large investors, whether that's kind of a cross section of the investor base. It depends on the company. But generally speaking, that is a good problem to have that not many companies, get the luxury of dealing with. So as you're planning, especially with expectation management, everyone should be going into the IPO saying we should be executing this transaction what's best for the company, which often means capital raising for the company, and saying everyone else, you're gonna have to wait 6 months before you'll be able to sell. And for large holders, that means perhaps you'll be waiting a little bit longer until you can do it in a more standardized manner, and it won't really impact the stock price at the time of the sale. So there's variation in practice, but generally speaking, it's 180 days for a lockup, clear market provision, and IPOs are predominantly primary offerings.
Interesting, because here in San Francisco, Silicon Valley, we're seeing a lot of secondary activity, in the year or two leading up to the IPO.
That's right.
And so do you see companies, doing formal plans to have the founders and the employees selling on the secondary, in a year or two before the IPO? Or do you think would you guys all recommend against a company doing that?
Secondary markets are, in the private company context, are becoming more popular, especially for larger companies that have, better brand recognition. And that takes some of the pressure off of companies in the timing of the IPOs, because if you've got employees who are able to take some cash off the table, over time, then you don't have an employee base who's, knocking on Drew's door saying, "Hey, when's this IPO going to happen? I want to buy a house."
Yeah.
And so there are benefits of the market becoming more robust for private company securities, but generally speaking, there's going to be an illiquidity discount associated with those sales or a tender offer. And so, people try to wait until you're public, because then you don't have that illiquidity discount. You can sell into the market and you get the full value of your share.
What did you guys do anything like that, Drew, before your IPO, or you kept it tight?
Are we tight? We're not tight. Look, I think we're pretty thoughtful and reasonable as how to think about it. So you got to be some level of flexibility. I think if you go back, and I think of a company in our space, they went public at $100 million of revenue, and then 5 years later, similar companies were going at $200 million of revenue. Right? Then the market locked up. And so, the two, it became like 500 or 700 is the new 200, 200 was the new 100. And the point with that is that it's a longer track to IPO today, right? And so, when companies might have gone public in 3 to 5 years, it's now taking closer to 8 or 10, very often, right? Or 7 to 10. And it's a longer trajectory. And so I do think it's reasonable that, employees will expect some liquidity. And I think having a reasonable policy in place, and, maybe it's tenure based, how long have you been here? If you've been here 5 or, some period of time. I think we did something like that, for some employees selectively, let's say. But I think that's a reasonable thing to do. And I think it's very common. Again, I'm in San Francisco area too. So there's, trillions of market cap potentially coming here very soon to market, with the AI related companies. And so, all of those, keeping those people in place, I think is part of that program right there, right? Because they're getting money thrown at them right and left. And so I think the employees feel that they want to participate, and I think the management teams feel that that's probably a fair request.
Right. Yeah, that makes sense. I've met so many people in the last 2 weeks who spent 1 year and 1 day working at OpenAI. 1 year, one
Well,
day.
I can tell you right now that the housing market here is reflective of a lot of liquidity.
Exactly. It sure is.
Yeah.
Austin, let's talk about some due diligence issues. Intellectual property, customer and supplier contracts, regulatory exposure, pending litigation, related party transactions. What diligence issues do you see most often surfacing in the IPO process? Maybe sometimes ones that companies might not have seen coming, and how would you advise your clients to de-risk these issues in advance?
Yeah, every company has its own flavor of diligence issues that you have to work through,
Mhm.
whether it's, an IP strategy that hasn't been fully thought through or there are holes in it. It's litigation that's ongoing. It's related party transactions that you need to clean up. It's unknown regulatory requirements that people just don't even realize they have to be complying with. And then somebody says, well, what are you doing to comply with this? And they say, I don't even know what that abbreviation stands for. And so the best way to get in front of it is to work with counsel early to understand what diligence materials are going to have to be provided and what kind of questions are going to come up on diligence calls. What you don't want to have happen is somebody sends you a diligence call question sheet and then Drew getting on the call and saying, I don't know what that is. Can you help me understand? Because then it doesn't just mean that you don't have an issue, but it makes you look bad to the underwriters and makes them say, is this really a deal we want to underwrite? They're not even aware of the issues we're asking about. And so you want to have surfaced those sensitive areas and say, okay, maybe we weren't compliant with this before, but we now understand what the requirements are. We understand what we're doing to, remedy that non-compliance. And this is our path to going forward. And so that you've got a thoughtful, comprehensive response to all of the diligence items. And then hopefully, by the time you're actually putting together the S1, it's no longer a diligence issue. It's just you're in compliance with whatever the regulatory regime is, or you've gotten the cap table cleanup already completed, so all the shares are now duly authorized, or there's no longer a related party transaction with the CEO. That's all taken care of. And so understanding what's going to have to be provided, because a lot of the private companies have never gone through this level of diligence before. And so understanding what's going to be asked and understanding what you're going to have to disclose and making sure that you're comfortable with the answer that you're going to give. So you're not giving a half-baked answer for the first time on a call with the underwriters.
Just to put a wrapper on that, one way to think about it is you're asking investors, I don't know how much everybody would be asking for, but let's say 500 million, a billion, multiple billions. You want to be credible. It's probably a good thing to be credible and not look like an idiot. Let's just be fair, right? And so don't undermine your credibility in the process. Be ready. One point just to follow on to Austin, think about the data room ahead of time and what's going to go in there because a lot of the questions sort of come out of that room. And so be ready ahead of time. One thing we did was had the data room ready, probably started getting that ready 7, 8 months ahead of time and thinking of all the diligence questions that would come up later so that we were ready.
I think that's a good rule of thumb. Don't look like an idiot. Just remember that.
Well, look, especially if you're taking $1 billion from someone, you probably want to look
Just
like
never look like an idiot. I think that's like the big
well,
takeaway here.
Questions do come up, and so be ready. It's critical.
Yeah. So okay, leads into the next question for you, Drew. Is when you brought on outside counsel and your audit partner, how did you choose? Was it someone you'd worked with for a long time? What did you optimize for? Did you have to switch out, given different experience? And what advice would you give to a CFO running that process today?
Well, I think first the thing is look at their experience, right? IPO experience is critical. Look, I think you're probably looking at the big four, typically from the accounting perspective. So get comfortable, with the firm and the partner. Probably if you're at my level, you probably already have some experience with one or more of the accounting firms, the audit firms. And so, look at that. see, look internally which ones were sort of best practices for you. Um, and that you felt comfortable with, and then
Mhm.
pick a couple, interview partners from both, and get that level of comfort. Ask these kind of questions that we're going through today. See
Mhm.
if they can add value on, um, and where at the end of the day, it's a comfort thing. Um, and then, from a legal perspective, I think there's a tendency to be, you're going to look at the firms that are doing the most IPOs, to be frank, because they're going to be used to working with each other. They're going to, that engagement, that continuing engagement with each other in the SEC is critical. Also, it's a comfort thing. You want, attorneys, a law firm that's going to be providing good advice, on how to path through the IPO and work through the issues. And so again, interviewing them, picking the right firm, interviewing partners within the firm, all of those things are key. Again, your general counsel probably is really going to lead that process. But again, as CFO, and you want to be obviously partners with the general counsel, but obviously you want to be meeting some of those people as well to see if you have a strong opinion one way or the other.
That's great. Thank you. So, Austin, let's talk about the Jobs Act tools, confidential filings, EGC accommodations, testing the waters, scaled disclosure. What's actually useful? What's underused? And where do companies leave optionality on the table?
Yeah, so I think the Jobs Act allowances are now pretty well worn. People know that when you go through the IPO process, you can confidentially submit your registration statement and work through a lot of the back and forth with the SEC and the benefits of a confidential environment. And then only when you are actually think you are about a month out from closing would you publicly flip and publicly file that S1. And then at that point, hopefully the back and forth with the SEC is at minimal. And so there's just not as much of the sausage making that's happening out in the public, and people generally follow that playbook unless there's a compelling business reason not to.
Mhm.
In addition, there's also the testing the waters process that we've hit on a couple times during this panel, and that is something that is incredibly important to getting a successful IPO. Generally speaking, once you've confidentially submitted the S1, it's go time for going out and meeting with investors. And you want to meet with them multiple times so that they're not hearing your story for the first time during the IPO roadshow. You want them to have heard the story, for you to have executed against what you said. And so you've built that level of credibility and trust with the investors. And so, the process in working with banks is pretty established in that, you go through these meetings, you get the accredited investors, you give them the presentation. You don't confirm sales, but you give them the ability to ask questions and pressure test your story. And hopefully at the end of that, you're at a position where you've got potential anchor investors you can potentially name on the cover of the S1 saying that they've indicated their expectation they're going to participate. That was really important in 2022, 2023 time. Now it's not as important, but still the testing the waters process is critical to making sure that you've got a robust list of people who are interested, who understand the story, and who are ready to take your call when it's time to go do the IPO roadshow.
Mhm.
And in addition, there are some, as John Michael referenced, there's a lot going on at the SEC these days, that they're working to make capital formation more easy or less inefficient for public companies. And so once you're public, there's also going to be a lot of tools for raising additional capital. And it'll be interesting to see how the SEC continues to progress the tools that are available and evolve them to reflect the kind of current states of the public markets.
Yeah, thank you. All right, so as you guys are thinking about the liquidity path, how would you advise folks on the call to think about doing a traditional IPO versus a direct listing or SPAC or a dual track with an M&A transaction? When does each one make sense? And, what should companies do early on to keep multiple paths of exit open to them? So let's start with, okay, Austin.
Yeah, so I mean, what's really important for it, this is board and senior leadership discussion of like understanding what the options are on the table. You need to understand what M&A options look like. You need to understand what the different paths to going public are. So you need to understand, what is a de-SPAC? What does that even mean? Why would a company do a direct listing? What is the difference between that and traditional IPO? And so there's some education at the front end. There's meeting with bankers to make sure that you understand what the market dynamics are for the company the sector that you're in. So, for example, the nuclear industry there were a lot of companies that were going public through the de-SPAC route, and understanding if there are any kind of industry specific or position reasons that you want to pursue one path versus another, and making sure that your board and management team fully understand kind of the complexities associated with it. The practical reality is that dual tracking M&A and IPO, there's a certain amount of bandwidth that the management team has, and trying to do both effectively is going to be a real time suck for everyone. And so, if that's what the board and your investors want to pursue, then you got to do it. But it is going to come at a cost, because it's hard to be out there, selling somebody or negotiating the final terms of merger agreement while you're also trying to do testing the waters meetings. And so there is a certain amount of just limited capacity that can constrain your ability to actively do both paths. High level, and I don't want to usurp or take over the conversation. So John, Michael, feel free to jump in. But traditional IPO, the benefits are there's extensive education process through the testing the waters pathway. It's the most well-known path for investors. They understand kind of what the playbook is, what the resulting company is going to be. There are fewer restrictions on the public company going forward. But there are also limitations that you're subject to market volatility, where you can be all dressed up with nowhere to go if the market's not ripe by the time your S1's gone through the SEC review process and you've waited the 15 days after public filing. If the markets go down, you just have to sit there and wait. Whereas with, for example, a de-SPAC, you can go out there and market a PIPE process and get people to commit to capital at the announcement of the deal. And then for sure that you've got some minimum amount of cash at the time you close, whether the markets are good or bad at that time. The downside of a de-SPAC is there are more complexities associated with it. There are higher transaction costs, and you don't actually know what the dilutive impact of the transaction is going to be, because you could have 100% redemptions from the SPAC trust, or you could have 0% redemptions. So there's a little more uncertainty on the back end, but there's more certainty on the deal getting done through the de-SPAC process. So understanding the complexities associated with each of the different paths is important, so that everyone kind of aligns on what makes most sense for the company, and that's the one you're pursuing.
Yeah.
I might touch on or add to that maybe. It is really, really common that companies will dual track. I totally agree that it is very hard to manage a dual track process, but it's very common. So I think first, I totally agree, Austin, you need to understand the paths that are available to you. I think often what we see is companies eliminate a couple and try to go down maybe two paths. So often it's a traditional IPO and a private sale. So I think eventually what tends to happen is you pay attention to the market multiples that you're receiving in that process or are projected to receive. And if one or the other path makes sense, maybe the multiples are close and you don't want to deal with the kind of governance requirements of being public, well, then you sell privately. I think what you can do, because you did ask about this too, to keep multiple paths open is, pursue those possible paths, but also just prepare early so that your financial statements are SEC compliant in the event that you do need to go public to achieve a better market multiple, if you will. And make sure that your governance meets public requirements. So any path, regardless of if that's a traditional IPO, direct listing, a SPAC, or whatever it tends to be, will ultimately require that you have SEC compliant financial statements and governance framework. So I think that'll help you keep all paths open, but I do think it's important to kind of whittle those paths down as you get more information.
Yeah, that makes sense. I think we've got time for a couple more questions. So Drew, and you don't have to answer this if you don't want to, but so the CEO CFO partnership in this window is uniquely intense. What works, what breaks? How should a CFO think about managing up when a founder or CEO is going through an IPO process for the first time?
Yeah, look, I think it's be open and honest, right? You have to, I think for the relationship to work, and I know this is sometimes challenged, I think you have to give, I always view my role as primarily an advisor. Um, I'm not here to be a babysitter, right? And you don't want to come across that way. But I think it's helping draft the process and think about what you're actually trying to accomplish. And I think this goes back even a little bit to the last question of what type of liquidity event do you want? Are you thinking long term? How much capital do we need? Are you optimizing for near-term price? And, that's sort of an M&A track, let's say, right? Or, you just need to go. And so I think it's making sure that you're thinking about all the long-term things, or getting on the same page in terms of what you're trying to accomplish. I think it's the CEO's company, right? And so, I think the CFO's there to help him achieve his objectives while balancing to ensure that the right message, the transparency, the credibility is coming through with investors so that you're composing an investor base that's supportive, hopefully over the long term.
Yeah, that makes sense. And I think that, ties into the next question too about board, how you're interacting with the boards. And, John Michael, how would you think like an audit committee on the board, what should they be thinking about? How should they be advising and working with management? And do you see any gaps too in the makeup of a board, 12 months out from an IPO that companies might want to think about adding?
Yeah, I guess similar to earlier comments on the finance function, likewise, the board of directors can also take time to build and time to optimize. There's no clear pre-filing requirements for boards, but there are requirements that exist that are either at effectiveness or later. Again, that said, best practice suggests that your board and your audit committee should be functioning well before filing and should be a part of building the relationships that we've been talking about through the panel. So that means your independent director should be onboarded. You should have a financial expert in place or have plans to put one in place. You should have regular audit committee meetings that are occurring already. I would suggest board governance and key responsibilities be in place. So that's oversight of financial reporting, that's internal controls and in a relationship with the auditors, helping set tone at the top. Those kind of basic things that you don't think about should be important 12 months or so out. I think as far as gaps, I think it comes down to people in practice. So often private boards don't have public company experience. They are too operational or they are operational and lack those kind of governance elements that make a board public ready. So I would just say you can't build that in 3 months. You need to plan for that and execute just like any other area of IPO readiness.
So this is a question for the panel. Market timing. Do you control it or does it control you? How does a company stay genuinely IPO ready over an unpredictable window without burning your teams out?
It's a great question. Obviously we can't control interest rates. We can't control the market. What we thought about what were the best windows of opportunity to be ready for those various windows. And, one example would be that, sort of August is a very quiet month on Wall Street. Capital tends to build. And we chose September for that reason, thinking that we would come back, have a nice opportunity with, sort of capital building in the market, people coming back fresh to the story. we talked about the engagement and the testing the water phase, but
Mhm.
let's even kind of dial back further. One of the most important things that you can do in the process, again, just talking about investor engagements, we did 280 investor meetings, right? And beginning with attending a lot of bank and investor events, um, telling our story, digging around the roots, so to speak, and getting people to know who we are.
Mhm.
We did an NDR 10 to 12 months in advance, talking to probably top 30 investors. Then we did testing the waters. We went through a testing the waters phase and finally a roadshow, along with the roadshow video and all of that, right? So
Mhm.
all of that engagement builds up. We timed all of that, to the various open windows, with September coming open for us being a
Mhm.
very good time for us to go public. And so, all of that worked very well. But there are times that I think are better. Obviously, you have to position that around your quarter ends,
Mhm.
because obviously there's quiet periods, um, and all of that, and then also considering, do you want to refile? And there's dates where trigger, if you wait too long, you may have to close the books again and refile.
Mhm.
So taking all of those things into account, again, it's a project, but think about the best windows with the best liquidity, the best availability of the investors to hear the kind of final, to spike the football on the story, so to speak.
Mhm.
That's how we thought about it.
Yeah, that's great. Obviously, you guys did a lot right. So I love this closing question. Is you're preparing for an IPO is a real test of what a company decides to carry with it from being a private company to a public culture, mission, values, the way it treats its people. This is something that's near and dear to my heart because I'm working with founders at all different stages to set aside either personal and or corporate equity to fund their social impact. And we've seen a lot of companies and worked really closely with Nasdaq on this, with Chime and Circle and Reddit, and, all the companies that we helped, either right before their IPO or earlier in their journeys to, create a culture of giving back. And again, everyone on this call, if you're interested in that, I'm happy to take calls with any of you one-on-one. But for the panel, is when you think about what's the one thing that you'd encourage every leadership team to lock in before the bell so it survives in the years after in terms of mission, values, culture. Um, Maybe let's start with you, Drew.
Yeah, look, I do think the culture of giving is important because it makes, again, a company is not, it's about the company as a whole and the culture, right? And
Mhm.
having people committed to some cause, I think is, you know, gets people sort of in a giving mode. We chose mental health, for instance,
Mhm.
as a cause, and if you look over the last 5, 10 years, that's become a really big, I think,
Yeah,
item for people. And I think it was a very engaging way to get people to just think more broadly than just focusing on financial goals or, individual goals, and collectively that we're solving the broader good. And I think that really pulled people together in a big way. And, we had some very successful, rounds of raising money for that, and something we're very proud of.
that's great. Yeah, we've seen a lot, that with a lot of the companies that we work with, that the employees who are sort of engaging with those, causes that the company gets behind are, very oftentimes the ones most likely to stay, and over again, the top performers, the ones who really care about their jobs, their clients, their customers, their communities. And so I really like that. Um, to less technical. Um, I guess, Colin, you can tell me if we're going to get the hook now, if, we want to open it up to the panel for questions or.
Perfect timing. We do have at a planned break, but we do have a couple minutes for some live Q&A. First off, Jan, thank you so much for leading. What a wonderful discussion. John Michael, Drew, Austin, awesome stuff. And we had a little fun along the way too. So we got some questions. Let's see. What do we got? We got a bunch. Trying to get the one. Oh, I like this one. So I'll put it up to whoever wants to jump on it, but what did today's IPO ready companies have that 2020 to 2021 companies didn't?
I'll start if others want to join. I presume that some of the 2020 to 2021 is in reference to the kind of booming SPAC market, which is when a lot of that activity occurred. So I think there is a big difference in the acceptability of a SPAC merger these days. The SEC really frowned upon that, though they're coming back in vogue. So I think that's a big difference that you're seeing is just there was a tendency for SPAC mergers to allow companies to go public that weren't truly ready because of the speed at which you could get a company public in that era, which is part of why it came under scrutiny by the SEC. So now that we kind of understand that you need to really be ready, a SPAC merger is more acceptable these days. But I think the overwhelming, more traditional path is a traditional IPO, which requires either way to be ready. But that's, I think, the big difference is just the readiness of those companies.
Yeah, there's been a lot of companies that have been sitting on the sidelines now for years,
Yeah.
hoping to go out. And so the companies today have 4 more years of preparation and time spent getting ready that those companies in 2020 and 2021 said, there's a market window, I'm going to jump through it. And so you're getting much more mature public company ready companies right out the gate as opposed to, companies that are just looking to access capital.
Everyone's curious about this crystal ball question. Is the 2026 health tech IPO window open, closing, or just cracking?
Again, I'll start. I think windows are open for the right company. Health tech is one of those. So I do think I agree with our earlier comments that the majority of capital right now or focus in this market tends to be on AI data centers, that space, right? But certainly for the right company, what we always say is the market window is always open, regardless of the economy. So I think the best thing that you can do is prepare your house, get your house in order to be able to capitalize on whatever that market window is that you perceive. And I would certainly say that I think this is as open as any other window or industry.
What a great answer. Austin, any comment?
Yeah, I agree. I think that there are investors who are looking to invest. You just got to be ready, and you got to make sure that the amount of time that you have to make sure that your house is in order, as John Michael put it, because there's so much that has to happen beforehand, and you can't just access the markets immediately.
Just one note on that. And, again, the focus clearly is on AI and AI related companies. Look, I think probably almost everything, and I'm, again, more tech centric, but almost everything has some sort of AI story, whether it's the internal operations, the efficiency element or the market opportunity, for AI and related AI tools. But look, these companies will go public. The valuations, can't predict. I can't really predict the valuations of these, right? But at some point, investors are going to look for alternatives because if they're frothy, then the big investors are going to say, maybe there's a better time to come in. And if you look at some of the IPOs, companies do tend, sometimes they go up, right, post-IPO, and then they come back down. And a lot of times that's because the big investors are saying, well, you know what, I got to take the gain off the table. And so that capital needs to get redeployed. And, if that phenomenon occurs, after some of these bigger name IPOs, then those are clear opportunities for, whether it's health tech or whatever industry, that capital needs to get redeployed. So about thinking about those windows on the heels of these broader IPOs, because, there will probably be those opportunities, stocks go up and down, flavors go, companies go in and out of flavor or industry. It's not necessarily company, it just may be the industry, it may be interest rates, whatever. But being ready because those opportunities probably will appear, over the next year.
Awesome. All right, well, I'm going to pivot. Instead of a key takeaway, which Jan pretty much wrapped it up with a big bow at the end there. Lightning round, because we are getting close to our planned break, but to each of you, what's one readiness investment that you think pays back the most?
Investor engagement, as I said, we did 280 investor meetings, non-deal roadshow, 10 to 12 months ahead of time, large testing the water phase, a significant roadshow. All of those matter. You want to establish and control your narrative, versus letting your competitors do it, and also make sure that you're building that relationship and credibility with your investors.
Awesome. John Michael?
Yeah, I'll say proper planning and getting the right people. We've said that kind of throughout the panel. I think both of those can really make a very challenging journey much more manageable.
Jan?
Oh, sorry, go ahead, Jan.
Okay, so I'll just say make impact part of your IPO story. It will make your company stronger, and it will withstand the test of time.
Awesome. Help us land the plane, Austin.
Entirely self-serving, but get good advisors in the door early that you trust and that can help you guide through the process, because especially if you haven't done this before or it's been a while since you've done it, having those people who have done this regularly, who know the rakes so you don't step on them, can make sure that you glide the plane and land smoothly.
Amazing. Well, John Michael, Jan, Drew, Austin, thank you all so much for sharing such incredible information today. We appreciate you joining us.
All right.
Thank you.
Thanks, everybody.
Thank you.
Okay.
All right, for our attendees, we do have a planned quick 5-minute break. So go refill your coffee cups, and we'll be back in a minute for our next panel on financial reporting and investor relations. We'll see you all in a little bit. All right, all right. Welcome back. So our next panel is going to be discussing financial reporting and investor relations, also known as From the Roadshow to the Bell. So please join me in giving a warm welcome to our panelists. We've got Liz Beyer, who's a founder and partner at Class 5 Group. Brian Turner, who's partner at KPMG, Liana Whittleton, who's a partner at Wilson Sonsini, welcome back, and Dan Angus, managing director at Nasdaq. Welcome, team.
Hey, Colin.
Nice to
All
be
right.
here.
Camera and audio is great. Dan, over to you. Looking forward to it.
All right. Hello, everyone. Thank you so much for joining us for this panel this morning and afternoon, depending on where you are. I'm joined by an esteemed group of experts as it relates to how to get growth stage companies from the roadshow to the bell. And quite frankly, they could talk about what happens even before the roadshow and then what happens after the bell. They are that talented. So we're very excited for this conversation that's going to be happening today. Without further ado, I'm going to ask the panelists to give a quick bit of background. Prior to jumping out, I should probably give my own background. Just by way of background, I am a managing director for new listings and capital markets at NASDAQ. In the event that any company is looking to explore a public market exit and wanted to understand how the exchange plays a role in both the lead up and the day of and afterwards, I am that individual to help educate companies on how we can be a partner and accretive through the process. So with that, maybe I could turn it over to you, Liz, and just if you could share your background and all the work that you've done in the space and give the audience some context, that'd be great.
Well, thanks for inviting me to be here. It's always a pleasure. I spent a long time as an institutional investor at T. Rowe Price, where at the time we were the largest institution investing in technology stocks, or at least with a dedicated technology fund. So saw a lot of IPOs from the perspective of the institutional investor. Ultimately, I decided to move from Baltimore, where T. Rowe is, out to California, where the action seemed to be at the time. And so I became an investment banker and saw the IPO process from the perspective of the banker, which is totally different from that of the institutional investor. I subsequently left that, briefly became a venture capitalist, and so saw the IPO from the perspective of the board. And then finally decided that companies going through the process know their business incredibly well, but they don't know the nuances of the IPO process. And so quite a few years ago, I set up an IPO advisory firm to work. I guess the analogy I use is to be the caddy for the management team as they walk the course of going an IPO from well before you get going till you're out there as a public company. And so the Class 5 Group is an IPO advisory firm that works sort of lockstep with management to guide through all the nuances of the process.
Fantastic. Thank you so much, Liz. And I'm sorry, I've known Liz for many years now at this point. So I'm gonna put her on a spot really quickly. If you don't mind, Liz, can you share any notable IPOs that you've worked on in the past, just to give some context as to, the great work you've done?
Yeah, generally, we don't actually talk about it because we want, I have a business partner in the East. I work on companies mostly based in the West, and we want the sun to shine on the management team. But it was long
Okay.
ago and far away. And, the big one that was certainly a very interesting transaction was the Google IPO.
Got it.
One that certainly everybody would know about, just a big consumer name, is Lyft. Cut the opposite end of the scale. Well, I guess these guys are super confidential, so maybe I won't mention it, but there's a big industrial defense tech company that has had a notable IPO. And there's been a whole bunch of them, but it's everything from semiconductors to Annie's Pasta was another one. So that's probably the full range.
She does it all, ladies and gentlemen. Thank you so much, Liz. I appreciate it.
And hundreds of them in the middle.
And hundreds of them in the middle. Okay, thank you, Liz. Brian, we're going to go to you. And first, I'd like you to tell me how often you wear that bow tie, because you are by far the most sartorially correct person on the panel today. Well done, sir. You look fantastic. Your background, please.
Thanks, Dan. I appreciate it. Brian Turner with KPMG. I'm an audit partner, and I lead our KPMG private practice in the Mountain West. I wear a bow tie because I keep, as I tell my audit teams and my clients, I like to keep the audit classy, Dan. So I've been doing that for years. I've been at the firm going on 20 years, and I've been wearing a bow tie for about 18 of those. But I help, from a overall accounting, auditing, financial reporting perspective, help my companies go through and get ready to become public companies. And then, as they've gone through the SEC filing process, we take them and, they flip over and get into the normal regular cadence of everything that we're about to talk about here, Dan, right? So what does it actually mean to be ready? And, as a longtime runner, I equate the IPO process to running a couple of marathons. So not one, there's always two. There's getting up to ringing the bell is a marathon in and of itself. And then the second half, once you're public, is the second marathon. So if you're not a runner and you're ready to go on this journey, well, lace up your shoes and we're going to take you on a wild ride here for the next hour. So.
I love it. I think the audience can appreciate the fact that when you're talking about IPOs, metaphors, analogies just run rampant. So the marathon is a perfect example. Thank you, Brian. I really appreciate it. And thank you for being on the panel. Liana, if you could share your background, that'd be great. And what are the odds that you can moonlight as someone that can keep me out of legal trouble on these types of webinars? I'd really appreciate your help in that, please.
Not just moonlighting, I will here to provide you the guardrails. It is great to be here. I do love being on these panels. As mentioned, I'm a partner at Wilson Sonsini. I've been here my entire career, working really on the company side with late-stage private companies getting ready for an IPO, doing the IPO itself, and then staying on for that public company representation. So I will definitely agree with Brian. There's sort of two pieces to this. No, only people talk about the IPO. They don't talk about what happens the day after. And we've got a couple questions on that category because it tends to be less of the focus, but frankly, the beginning of that whole new life cycle for a company. So we are happy to support our companies on that side.
Awesome. Awesome. Speaking of phases and sides, Liana, can you start us off and this is going to go to the entire panel, but just starting with you, Liana, can you help us understand about when a company, what that inflection point is where you're preparing to go public and then you're preparing to be public? It's a little shade of gray here that I think companies would appreciate having your perspective on.
Yeah, and I do think it is a process and there are shades of gray, right? And so I think there are some decisions you need to confront head on. There's some decisions you want to be thinking about or keeping an eye towards, but we can kick that can down the road a little bit. One thing I do think, and you're going to hear me say this a lot through this presentation, metrics tends to be something that people don't always pay a ton of attention to in terms of the longevity. They're just like, what sells my company today? What do the banks want me to report? What are my peers reporting? This number looks great today, right? But it is something that survives with you quarter over quarter after you go out. And I've definitely done companies, a year out are like, that might have sounded great in the S1, but really that's not how we think about our business, right? Or maybe that's a slowing metric and it doesn't look quite as good, right? And that's always the dangerous area is, something that you don't want to present just what looks good at any good period of time. You've got to be consistent in thinking about it across the way. So there is a ton of focus on metrics and you're going to hear that again and again, but I think people don't often think about what survives with you thereafter. So that's probably one of the early pieces. You spend a lot of time talking about it, but just really, as you're thinking about your finance team and getting ready, how is that going to look sort of period over period?
That makes a lot of sense, but that also leads me to ask Liz, when we think about that strategy involved that Liana was talking about, the idea about metrics and what to think about and what to report from a long-term standpoint as you prepare to be public, that's a pretty heady conversation. What do you advise your companies to think about, and kind of how do you help them get into the right mindset for thinking strategically about something that they haven't ever been through before, most likely?
Yeah. And first of all, the company should be working on building the strongest company that it can. The IPO is the tail. The key is the dog. Maybe I shouldn't call these companies dogs, but you get the point. Build the strongest company.
We have it on record, by the way, Liz, that you just said that. So
my business is posed.
Continue, please.
So, all right, you're building the business. Things are going the right way. There are lots of good reasons to go public. To Liana's point, metrics matter a lot. First thing to do, you're going to have a funnel. What are the things that you actually look at, you as a management team look at, and watch from quarter to quarter or year to year, or whatever it is? Now, what of those things are you going to be willing to share with the public, and what do you not want to share, either because they're volatile and go all over the place and people can come to the wrong conclusions, or because you don't want your competitors to know. And so you end up narrowing the funnel to what are the things that will help an investor understand how my business is doing and will not put me at a competitive disadvantage to someone who's doing what I'm doing. A quick example, because we did talk about Google. Yahoo had been public long before we were, and Yahoo and the other search engines at the time used to talk about ads per page. How many ads do we run per page? And that was great. That got everybody all excited about, okay, so Google comes along and goes, we know that that's what the other guys do, but we run news stories. And in fact, at the time of the Google beginning of the preparation, there was a large tsunami in Indonesia. And we had massive hits on our page to people finding out about the tsunami. Interestingly, nobody advertises on the word tsunami. So our ads per page were not good at all. Had we chosen to use that as a metric, investors would have come to the wrong conclusion. But we had to walk through the narrative to say, I know you look at this over here, but here's what you want to look at over here. And you can do it both because some of those metrics are misleading, but you can also do it because you just don't want to show them for one reason or another. But the key is, what are the things that actually drive your business? How can you help investors understand how your company is doing without putting yourself in any sort of a disadvantage?
Yeah, it just quick follow up on that one though. You mentioned about this shift from having an investor base potentially saying, I want this type of data point. And then you have the company saying, no, wait a second, you actually want this data point. How do you massage that and square that circle? Because it seems like initially kind of a confrontational point of view.
It certainly sometimes is. And the key is to say, no, I understand you see this from these folks, but here's why it won't be helpful to you. And if you really want to understand our business, you need to look over here. And sometimes there's some obfuscation in that. But the point is building and thinking about the narrative, both for which items you want to display on a quarter to quarter or annual basis, and which ones you definitely don't. And that takes thinking. And I would say most companies that I deal with, and I start working with them as much as but as much as 18 months before their IPO, unless it was companies that thought they were going in 2022, in which case it was years before. But you don't think about your business that way. You think about, how are you going to grow your business now? And so it's the reason to begin some of the conversations fairly early.
That makes sense. Thank you, Liz. And Brian, we're talking about KPIs. We're talking about these gray periods and interstitial periods before you're public, but still very sensitive. Like, please take this question in any direction. But when you reach this point in the process, like, what are you trying to advise your clients to keep them on the straight and narrow when it comes to reporting to make sure that nothing really bites them at the tail end of going public? Any thoughts on what you're doing in this span of time?
Yeah, Dan, back to the running analogy, an IPO is a journey, and, to start training for a marathon, you got to get out and just get some miles in, right? And so at some point, we always talk to our clients and advise that, hey, building the right team, not just internally as you approach the training and the journey, right? But also externally, right? So your service providers and, who are you enjoying time with, right? Outside of, just like, hey, we're going to get to know each other on the surface, because you're going to dive deep with all of these people throughout the entire journey. And part of that is building muscle memory, Dan, right? So from, a readiness perspective, right? It's a journey. And at some point, there's stops and starts, things that are in your control. There's a lot that's out of your control. But at some point, if you've got the muscle memory, right, and you've built the foundation, that goes a long way. And if you don't have the muscle memory, right, most people don't start training for a marathon 8 weeks before they run a marathon. Most people, it's compound effort over time. And, they add, different things, nutrition, sleep, they take breaks, they do intensity workouts, they do distance workouts, right? At some point, the IPO journey is no different. And again, splitting it into 2 races to get to ringing the bell, that process can start 3 to 6 months, depending on the maturity and sophistication and where the company is at. That can start years in advance, right? And then again, as we kind of fast forward to after ringing the bell, knowing that you've got the right people on your team, the right athlete on the field at the right time takes time. And sometimes you don't know what you don't know until you get there. But again, for our clients, we try to steer them in the right direction along with Liana and some really good legal folks, right? Because at the end of the day, going public is as much as an accounting exercise as it is a legal exercise. And there's a pretty robust framework for the rules and regs that the SEC expects and requires as you lead into the offering document. And then on the other side, once you're a public company, right? So it's a bit of a journey, Dan. So
Yeah, I love that. And very quickly, if you're going with the training analogy, if a company is going to prepare to get that, or is going to try to get that muscle memory starting today, right? And they're, let's say, 6 months or maybe 18 months out, you choose the time scale. What are one or two things that you'd recommend that they start doing today that will help them tomorrow?
yeah, from my perspective, Dan, it's really about people, systems, and processes, right? People are hugely important. And, I know some companies out there, you've got a short list of folks on your bench, and other companies, you've built that bench over the course of time. But I can't stress, from a people perspective, right? It's the greatest capital asset of any company and any firm in the world, right? And if you don't have the right people rowing in the right direction to achieve the goals and milestones and KPIs and targets and like you name it, as you go through this journey, it's going to be hard. Now I say that, right? We're at a bit of an inflection point, not just, in the business world, but in society with technology. And what are you doing to embrace technology and the rapid pace of change that technology is, bringing upon organizations, sometimes, on an hourly basis, sometimes daily, weekly, it depends on your industry, but are you ready for those changes, and can your business sustain those changes both from a systems and a processes perspective? And so, Dan, you got to pull it all together, right? There's no one quick hitter that gets it all done, but part of building the muscle memory is making sure that you've got the right people over the course of time as you go on this journey.
Yep. No, that's great counsel. That's great counsel. Liz, I'm going to come to you in a moment about more of a long-term process along Brian's lines. But Liana, I did want to ask you, let's just jump to the S1 really quick. What from the org meeting to, the first filing and the effectiveness, like what is the SEC review really like? And I'd love your take on the humanistic element of the reporter or the analyst that you're working with at the SEC. I imagine that sometimes they're kind of not treated entirely well, depending on the hecticness and the stress of the situation. But I would love maybe some insight, the qualitative pieces as to how best to appeal to them to have them view a company favorably beyond just what's in the filing.
And Leanna, I'm going to throw in that I made a golf analogy and Brian talked about running and rowing. We need a sports analogy.
Actually, no, that's a good point. I'm going to actually, Liz, I'm going to say, Leanna, you can go any analogy you want. It doesn't need to be sports. Up to you.
Well, we'll go broad. I do view the SEC as actually on our team, believe it or not. But I think when you approach them with that lens, it makes the engagement a little bit better, right? Like the SEC can be a pain in terms of some of their questions, right? But they are not in the business of keeping you out of the public markets, right? They're really in the business of making sure that there's sufficient disclosure, frankly, that you're protected as well from, unfortunately, the inevitable litigation that is going to come once you are public, right? And so they're approaching it from an investor disclosure perspective, but that can be helpful on your side as well. Now, sometimes you grit your teeth and go through those long lists of comments, but typically we do have a pretty healthy engagement with the staff, right? We will often call them. Sometimes it's just the lawyers. Sometimes we'll actually get the finance team on if we're trying to work through something on the accounting side, if they've asked a question. And, they're usually willing to take a call to say, look, I don't think you're actually understanding our business and why we're doing the revenue recognition the way that we do. I think at the extreme end, you can put in requests in advance, right, for certain review of accounting treatment. But even in the ordinary course, certainly as we get closer and closer and closer to effectiveness, it is an ongoing dialogue, right? And very frequently, the SEC will call us, we're on the road, and they say, I've got some comments. I'm not putting in a letter. I just want to make sure you address this in the final. And we say, thank you, God bless, and we will do so, right? So you do want to have a collaborative relationship with them. Yeah. But, in terms of the process, as Dan said, from org meeting to first filing, like that is the big period where everyone, all hands on deck, day in, day out, you get 100 emails from me. We're talking, all the time. In fact, eventually I'm going to lock you in a room with me, right? Whether it's on Zoom or in person, until we get this thing out. And then you breathe, right? And the SEC takes about a month, and then they get their comments. And then you spin up again, and it's kind of a 2-week cycle of what did they comment on, and what are they fighting us on, or what are the accounting issues? Can we turn this right away, or do we need some more time? Is Brian's team on the phone? Because there's some help we need from them, right? So it tends to be the spin, and then it gets quiet again for 3 weeks, and then it comes up again. And so it is a sort of very weird episodic, and it gets kind of faster and faster in turns as you get closer and closer to effectiveness, right? And then you are out on the road, you're pricing, right? And everything kind of just moves very, very quickly from that point to the end at that very sort of last 2-3 weeks.
Yeah. Yeah. And really quick, can you give the folks on the webinar a feeling for, Atkins, Atkins SEC regime as opposed to Gensler versus Clayton? Like, any thoughts on, like, are we in a good place from a regulatory standpoint? Or what's your take on that? Love your take.
Yeah, and you definitely see these sort of swings back and forth, kind of tied to administration, sort of lagging one year off, right, as changes are implemented. And so I think right now the overall mandate is let's get companies public. We've been in a dry spell just from the market, right? Let's not throw up more and more barriers to that. Let's really try and facilitate the process. And so kind of in the last 10 years, you'll see a range of that initial comment letter. It can be 80 comments, or it can be down to 30. And you do see this sort of yo-yo effect depending on what the SEC is focused on, what sort of bigger picture mandate is, what the market looks like. I think particularly during the series of government shutdowns, right? There was a lot of, I sort of appreciated more that like, these are just people trying to do their jobs. And, we would have these calls like, well, what are you reviewing? What is the timeline going to look like? How quickly can you clear us? And what have you been asked to review in terms of level? Because we're a month behind and everyone wants to get going.
Yeah.
So overall, I mean, I do think there is, I'm going to say a sort of friendlier or an issuer friendly approach right now in terms of really wanting to get companies out, thinking that IPOs are good for business, good for the market, something that at a high level, right, the administration wants to be supportive of.
Awesome. Thank you,
And
Liana.
Dan, from that perspective as well, just one thing to add, obviously it ebbs and flows, as Liana said, but I think over the last few months, you've seen, right, for anybody that follows what's going on with the SEC or reads the journal on a regular basis, the SEC has proposed certain things that could potentially change the accounting and financial reporting framework, right? At some point, if you rewind to pre-SOX 25 plus years ago, access to capital wasn't as hard as it used to be, right? And if you look at SOX compliance and evolving over time and what does it actually mean to do everything Liana just talked about, go on your roadshow and then become public and kind of that journey as a public company, but potentially eliminating interim review requirements, so quarterly reporting and going more to like a half-year model, right? Potentially changing the definition of a large accelerated filer. Again, some of this is hot off the press like in the last week, right? And so there's exposure drafts that are going on. But if you look at where we're at and where we're headed, obviously some of this stuff, as Liana said, it ebbs and flows, right? But we're in a time where I think, the SEC realizes that like, hey, they saw a very large decrease of companies' ability and appetite to go public because a lot of reporting requirements, a lot of stringent things going on, right? We all hear about the dry powder that's sitting out there. Access to capital has never been, right, any more than it is now in 2026. Rewind 5-6 years ago during COVID, right? There was a lot of uncertainty. So I think as technology evolves and as the rules and regs of the SEC evolve, we'll start to see things, maybe shorten a little bit from a cycle time perspective as well, Dan. So
Yeah, Brian, you're tempting me to ask you, give me a list of all of these new SEC proposals and tell me if, from your perspective, if they're good or bad. But I'm not going to do that to you because that can get us all in trouble. But hold that thought. I might ask you later. All right. Thank you for that, Brian. Appreciate it. And then Liz, just really quick, like on the, if you think about the 18-month horizon, which is the typical benchmark for when a company starts their prep in earnest, right? I imagine per Liana's comments that, that 6-month time frame from org to listing, like that's the intense period. But outside of that, in the beginning part of that 18 months, like what are you counseling your companies to do on a consistent basis that is most accretive to the process?
I will get there as long as you promise to come back to me on the rules and regs, because I have on the SEC, the
Oh,
current
well,
SEC, because I
I've
have
read your
strong opinion.
LinkedIn. I've read your LinkedIn post. We can start there if you want to. We can go semi-annual reporting. I didn't want to put you on the spot again, but if you'd like to.
I like to be on the spot. No.
All right, let's go.
I have worked with companies going public now as a full-time thing for 17 years. I have never once heard a company say, well, we're not going to go because we don't want to follow up with Sarbanes-Oxley. We don't want to go because quarterly reporting is too hard. Never once. Companies don't go for a couple of reasons. One, because they're now, thanks to the Jobs Act of 2012, there's so much availability of private funding, they don't have to go. And that was if the SEC really wanted to encourage more IPOs, they would reinstitute something that was called the 500 shareholder rule. And that rule said if you had 500 shareholders or option holders, you had to file your information publicly. You didn't have to become a public company, but you had to file what was called a Form 10. And many companies, including Google, including Facebook, said, well, we're going to put our numbers out there. We may as well use that as the catalyst to go public. The venture capital community successfully convinced the powers that be that that was a bad idea because they liked holding onto stocks longer in their growth period. And so they used the Jobs Act to effectively keep the public out of the markets while companies were in their most rapid phase of growth. Opinions. So if the SEC really wanted to encourage IPOs, they would once again say when you've reached a certain scale, you have to share your information with all your investors equally, which really isn't such an onerous thing. But what concerns me about the regulations that Brian was just talking about is they're very issuer friendly. They're very investor unfriendly. By definition, IPOs are riskier than companies that have been in the public markets for a while. And if, in fact, you want institutional investors who are investing other people's money to feel good about investing in riskier assets, you have to give them enough information to give them some level of confidence about what's going to happen ahead. Or you have to be willing, since it's always about risk and reward, to say, I'm giving you less information, but that means I get a lower valuation, risk and reward. So I think that these rules are, I strongly disagree with that making reporting semi-annual will encourage the IPO market. I think it will harm it much more than it will help it. Just as the Jobs Act is, you can see the clear demarcation. When they got rid of the 500 shareholder rule, that's when the IPO market started drying up. So your question was what to do for 18 months. Sorry, you were going to say something, but
No. I think that context is phenomenal. And just to clarify, I think under the proposed rule change for semi-annual reporting currently, a company can elect to still do quarterly reporting, right?
It's optional, absolutely.
Got it. Okay, just wanted to get that. Yeah.
No, there's no other things you can't. I'm sorry, go ahead.
No, realistically, companies will still do earnings, right? The market is going to require it, even if the SEC doesn't.
Yeah, it's.
I love that. I love that.
If they want investors, they have to share information with investors to show them that it's working. Right? It goes back to the KPIs we were talking about. It goes back to your question of what do you do 18 months ahead. The first thing you do is you hire a Brian, because the thing that holds the most companies up is getting their audits done, because the way you display your numbers is different when you're private than it is when you're public, and it takes a while. And you need to figure out what is the appropriate revenue recognition. And all that stuff takes time. So that's the first thing you do. The second thing you do is you hire a Liana, because you need different outside counsel. And honest, this is not a paid political ad, but it is. You need your lawyer and you need your accountants to help you understand, to help the founders, particularly in the tech world, where we have a lot of really talented engineers who really understand what they're doing from a technical point of view, but don't know this other stuff. You need these guys as you need these people, these organizations to help you get prepared. So one of the other things you need to at least consider is companies, again, these are mostly tech companies in the Valley, share a lot of information on a weekly basis or a monthly basis with the employee base. At some point, you need to scale some of that back if you want your employees to be able to someday trade the stock, because you're sharing a lot of material, non-public inside information, which is absolutely fine when you're private. It is absolutely not fine when you're public. When you tell employees, we used to share all this with you, and now we're not, they kind of get offended because they didn't tell anybody, they didn't do anything wrong. So that's a gradual arc to begin pulling information back. I don't want to be yammering on too long, but those are three of the things. A fourth thing is, this is for senior management, who should be on your board? It should no longer be your all venture capitalists. It's what are the skill sets you need? Are you doing a lot of business in Asia? Do you have somebody who understands those markets? I don't know, you can figure out, do I need somebody who's a marketing expert? Do I need somebody who's a governance expert? Figure out what the skill sets are that you need and begin to look around for the right individuals that will fill those seats, as opposed to, I don't know, who do I know that I can stick on my board? Because they're with you for a long time. So anyway, long-winded answer.
Well, thank you, Liz. And that's a really good point for everyone on the webinar, just on the board selection process. So I work with companies that go public, much like all of my colleagues here on the panel do. But I get this really interesting front row seat in the sense that I often speak with companies that are going through their board evaluation 3 months before they go public, which implies not too much due diligence being done on the individuals that they ultimately bring in to be their boss. So my one request for everyone on the webinar here today that's anywhere near going public or thinking about it is that we take Liz's advice by starting that process earlier and doing a lot more due diligence, because again, they are ultimately going to be your boss that you have to answer to. You want a good, emotional, resonant relationship that is going to last through both high periods and low periods, and that takes time. So just a quick aside, PSA for everyone here. Brian, we're going to go ahead and switch to audit right now. And if you're bringing a company into the audit process and explaining to them, what this is going to look like. I mean, contextually, people understand what an audit is, but they don't necessarily know how everything is done on an intricate basis. Like, how are you bringing them through the process initially? What are you guiding them on? How are you meeting them where they are? And what does this audit process really mean in the context of going public?
Yeah, Dan, great question. Like I said before, from a people, systems, and processes perspective, right? You need to think about as you get through an audit. And again, I know everybody loves being audited because I love doing it. At some point, it's got to be a collaborative effort, right? And it doesn't just go to the debits and the credits. It's not just about your tax provision. It's how it all comes together into the document. As I said earlier, the SEC has a pretty prescriptive set of rules that have been around for a very long time on how companies go public, how they stay public, what are the specific metrics that people should be disclosing. There's a lot of information out there in the public realm, right? But if you take a step back from being a private company and going on that journey from accounting, financial reporting, governance, operational structures, and breaking down those silos and saying, hey, well, what does it mean from an audit perspective? Most companies as a private company are going through an audit from an AICPA perspective, right? Public Company Accounting Oversight Board, the PCAOB, requires a different set of standards. It's lower materiality. Auditor has to dive in a little bit deeper. And at the highest level, we're spending a lot more time understanding how the company goes through a month-end close process. That could be balance sheet recs. That could be, hey, how does revenue ultimately get to the income statement? That could be, how's the cash flow prepared? There's a lot of moving piece parts, right? And so if you've got one-off things that happen, like an acquisition, or you've got some type of debt financing that occurred or an equity arrangement that happened, there's a lot of technical accounting that happens along the way. And sometimes when you go from that AICPA to PCAOB step up, you can have restatements, right? That's not uncommon. So I would encourage everybody on this call to, if you don't already, at least have somebody on your accounting financial reporting team that knows and understands technical accounting. Or if you don't have the bandwidth and capacity to hire that person, go hire an expert outside of your company to help you get up to speed, to help you look around corners, to help you think about the things that are going to be coming down the pike, Dan, from just a normal cadence being a public company perspective, right? Segment reporting is a great one, for example, right? How do you know, understand, and run the business? Well, that could change, as Liana hinted at earlier, over the life cycle of your IPO journey. If you rewind 24 months ago, your company was a lot different than it was 12 months ago, a lot different than it was 6 months ago, and a lot different than it is today. But how does your chief operating decision maker ultimately look at all that information and allocate resources and make decisions on, hey, this is where we're going to invest capital, this is where we're going to skinny back, this is how we're going to approach technology? All these things matter because the SEC cares about them. And more importantly, Dan, again, I hinted at it earlier, but the systems and the processes and the controls that overlay everything, from not just from an accounting and a finance perspective, those matter across the company, right? That's how your engineers pull things together. That's how your salespeople ultimately sell certain KPIs based on bonus plans, et cetera, right? It is all a big interwoven web. And at some point, if you don't have a good grasp on each unique work stream that you're working towards as you go through this IPO journey, right? And I'll look at it from an accounting finance perspective. That's pulling together your financial statements, including SEC reporting. That's, hey, how do your systems talk to your ultimate like month end and quarter end close process, right? From a controls perspective, that's really important. Do you have an internal audit team, internal audit function? Are your business process owners involved in day-to-day decision making, or are they back-end review controls, that ultimately catch something maybe after the month is closed, right? From a tax structuring and compliance perspective, depending on where you're at, if you're domestic, international, what's the overlay? All of those things can certainly matter, and they are very, very important. And then you get to the point, and Liana said this, get to the point where you close a quarter, and then you need to go talk about it with investors. Well, what are those questions? And those questions could be endless. And that question could come from a human being, that could come from AI, that could come from some combination of both. And are you prepared as a company, one, to answer the question, and two, knowing when you answer that question, well, somebody could pull that up in 3 months or in 36 months or in 60 months. And how you answer that question the first time matters, because when you get it the second time and the third time and the 25th time, everyone's going to go back, and you can lose a lot of investor confidence if you don't have all your ducks in a row and you answer the question one way the first time, and the 10th time it's a little bit different, and the 25th time it's way different, right? That can either decrease or increase investor confidence depending on where you're at in that journey. And from my perspective, Dan, that all starts with the audit, right? And obviously Liana would say it starts with legal, and again, but it all kind of comes together because the audit brings it all full circle. And that's what you're going to disclose on a quarterly basis for the rest of your life as a public company until something else happens, right?
Yep. And I'm curious, just extending it beyond just the IPO. I'm just completely an aside, but starting the audit process earlier, before you're really thinking about IPO, from your perspective, Brian, and if anyone else wants to jump in, that's great too. But does that make you more of a compelling investment prospect potentially to cornerstone investors, or do you think that really just doesn't factor in?
Yeah, I think it depends, at least from my perspective, Dan. It depends on who your investors are and what is the audit requirement and why. Sometimes bank requires an audit to be done, 90 days or 120 days, and you got to issue those financials. Sometimes it's investor confidence, right? If you've got a big private equity firm in and you've been using a small or mid-tier regional firm, they say, hey, at some point we need you to upgrade that to a Big Four audit, right? But at the end of the day, again, it's about building that muscle memory, Dan, because when you do, I've had companies that have done anywhere from 4 to 10 acquisitions, public companies that have done anywhere from 4 to 10 acquisitions in a given year. Well, if you're on that journey and you're going down, hey, we're going to buy this business and that business, and 45 plus acquisitions later, how does that all stack up? It starts with building that muscle memory and going through that audit process. And the audit doesn't have to be painful. It can actually be very collaborative. I've worked with some of my clients, large digital infrastructure clients, SaaS clients, advertising companies, traditional telecoms, and part of it is the story and the journey that you're on, but it all starts as you're going through that process together, right? So.
Yep. No, that makes sense. That makes sense. Okay. So thank you for that, Brian. We're going to take just a breather here and just kind of walk back and look back at what we've covered so far. We've talked about what happens from a legal standpoint from the org up period to the ringing the first bell, that critical 6 months. We've learned about how best to communicate with investors and maybe shifting their perception as to which KPIs are helpful versus those that are not. We've realized the importance of muscle memory as it relates to the 18-month horizon. And so the one area that we really haven't farmed quite yet is the day of and the immediate aftermath as to what happens when you're public. And I'm talking within the first 48 hours. So maybe, Liana, I'm going to start with you, but direct this to the entire panel. Like, if you think about, let's actually extend that. Like, you think about the night before the first trade and the pricing, and maybe however much earlier you want to go with it. But let's say 2 days before and 2 days after the first trade, what's happening? What's critical? What should our entrepreneurs be thinking about when they get to that spot?
Yeah, I'm going to give you the management response. What I will note as a lawyer is while you are out celebrating pricing, there's a lot of documents that have to get turned in. And more than once I have had, documents signed with like the wine glass, stain on it because everyone's at a dinner where we're getting it signed. But from pricing on and the fact that closing doesn't happen until after the first day of trading, and a lot of times the management team's kind of moved on and forgotten. But from a management perspective, I mean, I think wrapping up the roadshow, right? Certainly for those that are on it is a very big deal, right? And you kind of, sometimes there's a meeting that last morning and then you come in for pricing. And that is your classic, everyone assembles in the big conference room in New York with the views, right? And the banks start walking you through what the book looks like. And I do think, companies often don't spend as much time thinking about who they want their investors to be long term. And so often pricing, right, and the banks talking about these people you've just met is the first time you're trying to figure out, not just did I like that person, did they ask good questions, do they understand our business, but are they going to be a good long-term investor, right? And that can mean holding, that can mean selling, right? And there's a little bit of a divergence on what the banks are solving for that, for pricing and what a company is solving for as well. And so I do think to the extent you're able to build out an IR function in advance and really think a little bit about who do you want your investors to be, not just in the book where you have complete control, but as people start selling, like who are you looking to take a position? Which investors do you want to meet with on a quarterly basis? And have you thought about whether they're consistent with ISS policies or if they ask their own questions? And a lot of that you don't worry about until you get there. And they're like, oh, we're having this question again. Okay, right? I vaguely remember the lawyers said that people wouldn't like these provisions, but to do it anyways, right? But I think that's something that it can feel a little bit overwhelming. I mean, I've definitely sat in these meetings and the bankers are going through the list of people and moving the share allocations, and you sort of see the management team glaze over a little bit on like, I no longer know who I want in and at what size allocation. And so I think that's one thing that can just sort of surprise people. Also, remember, you're coming off the roadshow, right? And I will say one of the beautiful things about COVID is we actually did a lot of remote roadshows, so you were fresh. But this get up at 7 a.m., you're in Chicago, now you're flying to New York, like that does take a toll. So when you get to pricing, you are a little tired, even though you're kind of buoyed by this excitement. And then I think the first day of trading, one thing I didn't realize is how long it takes to price that first trade, right? So you get up bright and early, you're down on the floor, standing around, right?
That's right.
You're sort of waiting and you're not even really sure what you're waiting for the first time you go through it. And the Nasdaq team, they've got a couple people with like the computers and the banks of computers, what you think of. And so you're sort of standing over the shoulder of some poor analyst who's been told they have to sit there while all 50 of you wander around wondering what you're waiting for, right?
Okay. Liana, let's just pause right there. Let's flesh out the picture of what's actually happening. I promise everyone on the webinar that Nasdaq is furnishing everyone with sufficient amounts of alcohol.
They are. This is
while
true.
this process is happening. You're not bored. Okay. Liana, please continue.
It's true. They have these very cool photo opportunities and they actually project them on the wall as you go. It's quite fun.
That's a lot of fun.
But then you actually price, and then all of a sudden everything speeds up, right? So you kind of spend that early morning waiting, and then it is all of a sudden you're ringing the bell, you're outside with the big Nasdaq wall and the pictures flash, right? And you're taking pictures in Times Square, right? And all of that can start then moving very, very quickly. One of the companies I worked with, I think I was impressed by their savviness, although I'm not sure that every company can do this, but they said, look, this is not just an employee day, right? Where it's a really big moment for our founders and our employee base, but this is also a strategic marketing event for the company. And we're going to do an entire like customer partner event, right? Because it's just a way to get in front of people, celebrate they're paying attention to you. But then you kind of tack that on to the end of all of these other events, and it is kind of a long day, if you will, right, for that first day of trading. And inevitably, right, the hope is you go high, right, and then you settle down. And then founders are starting to say, well, wait a minute, who got all that money? Like who made money off the pop? What did I price it at? Did I leave money on the table? Is that how it's supposed to go? Is that good? Is that bad? Right?
Yeah,
So there's a lot of up and down of emotions on that day. And then those annoying lawyers show up the next day and say, hi, we still have to get to closing. I need a couple more signatures from you.
Well, if they want the deal done, they need to sign. So I don't think that you'll have any much pushback on that one. Hopefully you don't. Thank you, Liana. Really appreciate it. So Liz, if you think about like one thing Liana said to me that I think is probably a good idea to touch on, kind of a divergent off of the main narrative line here, but there are a number of different ways of going public these days. And, she referenced the pop and, that made me think of direct listings. And then we also have the resurgence of SPACs and de-SPACs happening. I mean, I'd love to hear your thoughts on maybe not so much what's best or, what's good or bad, but, really just a sober assessment of the benefits and positives of each method of going public, perhaps.
Do we have an hour?
Look, you're gonna need to condense it. I'm putting you on the spot again.
No, it's all good.
There you go.
Okay. SPACs. Mostly, there are exceptions, but mostly SPACs have been for the companies that couldn't get it done the old-fashioned way. And people fail to understand SPACs will, in fact, get you public quicker. And that means you have to do all the things that Brian and Leanna have talked about in terms of getting ready while you're already public. It's like going into the town square and getting dressed as opposed to being dressed before you walk in. So again, there are some occasions where it makes sense, but often companies that have chosen the SPAC route either can't get it done the more traditional way or have some dirty laundry, frankly, in the past that they don't want to spend the whole trip talking about. I mean, that's just truth. So be very careful if you choose the SPAC route. Just look at the performance of most, not all, but most of them. The quick and easy way is not always in your best long-term interest. Direct listings, not that I have opinions or anything. Direct listings, we all see these tweets about, oh, they left money on the table. What does that actually mean? It means that the people who are taking incremental risk, your new buyers, are in fact getting the benefit of taking that risk. If you do a direct listing, there are two important things to know. One, none of the money goes at this point, none of the money goes to the company. A direct listing is the existing shareholders selling what they own to a new group of shareholders. And you can debate whether the existing folks who have, in theory, already made a fair amount of money should try to top ticket, or whether you do need to leave. Again, we talk that ideally a first day pop is 15%, and that's to compensate new investors for the incremental risk they're taking. Can you exactly make it 15%? You cannot. So that goes to the rest of your question, which is, so are there different strategies? And different companies will choose different approaches. There's the book build approach, and again, we don't need to get, which is sort of a traditional straight down the fairway IPO. There's my favorite, which is the hybrid auction approach, where you ask potential investors to tell you how many shares they want at different price points and which shareholders want your stock at which price point. And that way you can see if all of the professional investors, or the vast majority, are willing to pay $42 a share, but all of the less experienced investors are willing to pay $80 a share. you can decide who you want in that book. You can price at 42 and get the T. Rows and the Capitals and the Fidelities and the Wellingtons or you can price up here, put more money in the till, your stock for the long term. And every company has to understand, why is it going in the first place? Does it need to absolutely maximize dollars because it has use for those funds? Cool. Is it a marketing event? It always is, Dan, to your point earlier. Sometimes a big pop, frankly, gets more press. Maybe that's good. And one of the companies I don't think they'll mind I talk about that I worked with was Bill.com. Bill.com knew there was massive demand the day of the IPO, well above where the fundamentals said they should trade if you looked at the company as compared to the other companies in the sector. And that's, of course, a large measure of how companies, IPOs, are initially priced. Who are my comparable companies and how they're trading at 12 times forward revenue? I should probably trade in that neck of the woods. And the clever folks, in my opinion, at Bill said, we know we can price up here, but we also know that when sobriety hits, we're going to trade like others in our industry, and that's down here. So let's do a smaller deal right now at the lower price. Let's be public for 6 months and demonstrate to investors that, in fact, we are going to deliver what we said we would. And then when they trust us more in 6 months, let's do a second offering at a much higher price at much bigger volume. And it totally worked out. So did they leave money on the table the day of the IPO? Yes, they did. Did it make any difference 6 months later? Absolutely not, because they had gained credibility with the institutional investors and they were able to raise much more money at a much higher valuation 6 months later. So companies need to figure out what they're optimizing for, is the short answer to the question. There's no one direct answer.
And for those of you keeping score at home, the reverse hybrid approach that Liz had mentioned, she actually created it. So no joke. This was her design. So just a little feather in the cap there.
Thank you. The reason I like it is because management teams have more data, right? Management teams know where different investors are, and they can use that data to make the decision, as opposed to completely relying on their investment bankers, who can be very helpful, but investment bankers are serving two masters. So I believe management teams should have the most data possible before they make that pricing decision. But thank you for that.
Absolutely, absolutely. And so Brian, Liz was talking in part about defining who your investors will be and playing an active role in that. I mean, one thing, kind of maybe the inverse of this is kind of how, from a KPI standpoint, you can actually inadvertently back into a different type of investor profile depending on what you decide to accent about the company. I'd love your take on, what you counsel your companies when they're trying to define this series of KPIs that they're looking to bring to market. Where does sobriety or aggression, come in? Like, how do you help them think strategically about that?
Yeah, no, Dan, it's a great question. I will say, and Liana, I think you'll agree with me, the SEC consistently targets non-GAAP measures because there's just a lot of scrutiny over them, and there's a lot of things that you can do with non-GAAP measures to change them, right? And so again, your 10Ks, your 10Qs should be grounded in GAAP, right? But as you think about, Dan, hey, why am I putting this KPI in, or why am I going to talk about this? I always start with the why test, right? Like at some point, can you have a clear statement of understanding related to the how and the why? This ties back to ultimately your audited financials, how you drive the business. Again, back to what I said earlier, from a CODM perspective, how that individual or group of individuals that's making strategic decisions is not trying to mislead any investors, right? The SEC is there to protect the capital markets. That's KPMG's job. That's, the other big four's job as well, to make sure that we don't have things going awry. And so at some point, as you think about that why test and looking at that over the course of time, you need to be very grounded in the how and the why you get to the why test, Dan, right? At some point, you don't want your metrics changing and flying all over the place. And hey, you did this acquisition, but we're going to report it on this basis. Or hey, we've got this kind of goofy contract going on and it's a one-off. Like at some point, again, you always want the GAAP to be the GAAP, right? Generally accepted accounting principles are GAAP. Non-GAAP is not great, and the SEC is always going to deter from trying to lead people in the wrong direction, right? And so look at consistency again, back to muscle memory, like, hey, the how and the why you're getting there, make sure that it's consistent across various forums. As Liana said, when you're on the road show and you're talking about the company and you're getting ready to price, you need to be thinking ahead 6 months after you're a public company and 3 years after you're a public company, like, hey, what does this look like on a go forward basis? Again, the purpose of the SEC rules and regs is to protect investors. People don't want highly subjective KPIs, things whipping around, right? Because that just provides lack of confidence. And then from an audit perspective, it can be really hard to build the bridge, Dan, right? To get from point A to point B. If somebody talks about some non-GAAP measure on an earnings call, and then you see the stock price plunge, well, normally that's because management didn't do a good job of teeing up what that is, why that is, and why they're making a decision to make that relevant to investors.
Got it. Got it. That's a lot. And then also it gives me a bit, maybe you're going to tell me that this is not that big of a consternation point, but when I think about, large AI players like the OpenAIs and Anthropics, there is a very big line of how they report relative to each other and some marquee differences. Like just forecasting yourself out into the AI age where we have basically a completely new set of companies kind of bringing themselves to the fore. Like, do you think that Gap is going to change to meet them, with this new kind of paradigm, this new industry? Or do you think that, it's going to be like it has in the past, that these companies are going to have to bend to Gap, or is it going to be something in the middle?
Yeah, I mean, at some point, right, Dan, GAAP is GAAP, and the FASB spends a lot of time before an exposure draft goes out, and ultimately the GAAP is codified. And ultimately, like if you rewind and you look at, again, in the last 10 years, we've had 2 or 3 kind of very large GAAP changes, Dan, right? The first being ASC 606, so revenue accounting for revenue contracts. Obviously, leases came after, and then you had CECL. But if you rewind, how did the FASB get to 606, right? Part of that was investor transparency and like, hey, if you're selling a widget or you're delivering a construction contract and doing POC rev rec, right? Like at some point, it's more about clarity for investors. And, so I do think with obviously, there, and I see this all the time, Dan, right? I'll sit down with a prospective client and they'll say, hey, AI said this about GAAP. And I said, okay, well, that's great, but this is what GAAP says about GAAP. And right at some point, and Liana, I'm sure you get the same question or same kind of thought process of like, hey, well, the law says this. Well, the law actually says this, right? And so until the FASB comes out and changes and says, hey, we're going to bend and we're going to flex, like 606 rev rec is 606 rev rec, right? And I can help clients, and my accounting advisory services team can help clients think through, because GAAP is not just black and white. There is some gray there. But hey, how does this fact pattern, how does this contract, how does this upcoming large potential acquisition we're going to do, how does that play and overlay into the business and what we're ultimately driving towards? And that could be KPIs, that could be, hey, I know a lot of companies have a few non-GAAP measures that actually are very helpful to investors, right? But again, it's how you bridge the gap and you build the story, right? And part of that is not trying to surprise anybody on the road show, not trying to surprise anybody in your SEC filings, right? That's the worst thing, I think, Liana, and you probably would agree with me from our perspective, is no surprises, right? Like at some point, you don't want to fast forward and spook investors, because as soon as you spook investors, it's really hard to regain that confidence, Dan, right? And it can be a very small thing or it could be a very large thing. But once you've lost that faith, it's very hard to reestablish that over the course of time.
No, 100%. Thanks, Brian. And Liana, one thing that Brian said that made me immediately think of you and AI is, maybe I'm putting words in your mouth, and I apologize if I am, but maybe you could spend a little time about why having AI draft an S1 is not a great idea. or any other thoughts around the legal process in AI? Would love to hear your take.
Sure. No, I mean, I think, look, AI is going to change every industry. The legal industry is not exempt from that, right? And I think there are a lot of places where AI can be extremely helpful. It's an efficiency tool. It can be used just to speed things up, make things faster, right? What I don't think it does is replace judgment. And that's the distinction that you're going to, I have not come up with that myself, right? So where I might have had an associate spend hours building out a risk factor matrix to pull all the other sample precedent companies of your peers and tell you what their risks are. Perfectly fine if AI generates that for you, right? I still think you want me or an associate to say, well, but this is not applicable to you because, or guess what? I went through your diligence, you have a specific litigation issue and we need to talk about that separately, right? So I think as long as you know sort of what you're using AI for, right? Which is efficiency, improve, like comparing comps, like I love the idea that something can spit it out for me very quickly. I don't want my associate to go spend 4 hours pulling something for you just to say, yep, we should include that check, right? Like that's not valuable for you or for me, right? So I think it's the where, right? There's a lot of an S1, which is boilerplate, right? You'll hear people say the back half, right? You all as management teams are focused on business. You're focused on MD&A, a little bit of risk factors. There's a bunch of other sections you just need to know are right. Can we be very efficient with those sections? Absolutely, right? But you also need to know what you're looking for, what precedents are being pulled. Is that actually an accurate description? Because we do have strict liability, right? And my goal is to keep you out of handcuffs whenever possible, right? So, I think there's going to be a lot of adoption. I don't mind when, if the client says, hey, look, I ran this through AI and here's what it says. And I say, okay, 80% right, but here's the 3 pieces that are really relevant to you, right? And so I think it's useful as an education tool, but I don't think you want to be, or, we're not at the point where you can use it to shortcut some of the judgment drafting, like what do I need to worry about pieces.
Got it. Thank you for that. And that was my roundabout way to advising the audience not to use AI for any legal purposes, but instead talk to Liana. So just that was my goal there, if you couldn't tell. All right, we are coming close to time. And before we open it up to questions, just kind of a rehash on some of the things that we've been speaking about today. I mean, ranging from the fact that the SEC are human beings as well, and that they can be interacted with like human beings is a good thing. We also need to keep in mind that GAAP is GAAP, and it's not going to bend until someone actually makes it bend, and that's typically the regulator's job. And that there are multiple ways of going public, and you should definitely speak with Liz Beyer in the event that you want to delve a little bit more deeper into what is more appropriate for your businesses. So that's just a few of the topics that we covered, obviously, but the last thing that I just wanted to cover is an actual action item that our audience can take away to do tomorrow to help them prepare for an IPO 18 months from now. So Liz, we're going to start with you. If there is one activity that you had to nail down and recommend starting at month 18, or rather starting at 0, what would that first step be that you'd recommend?
Well, literally the first step would be to hire your auditors. But moving on from that, companies think about day-to-day operation. They think about how we're going to grow. The 2 things that need a lot of work are the forecasting, because if you can't get your forecasting right, you're going to do what you've just heard. You're going to trip out of the starting gate, and then it will take you a very long time to regain investor credibility. So one is really try to hone that forecasting model. And I would say the second thing is, and again, companies don't think this way. The hardest part of the business section is that little section that is our competitive advantages. What are the 5 things that you do better than anybody else? Because again, companies don't think of it that, but investors do think of it that way. So what are the 5 little succinct things that are going to keep you in the game long after this IPO, and start toying with them in your head because they'll evolve. What are they, and how could you stack rank them? And think about it when you're out for a run, or when you're, indoors on the Peloton or whatever it is. What are the things that we do better than anyone else, that any company that had a massive amount of funding could not catch up with us on right away?
Nice.
Hire your auditors, know what you do better than anybody else, and work on your forecasting. And that was 3 things, not 1, so I apologize.
Sage wisdom nonetheless. Brian, over to you.
Yeah, from my perspective, Dan, right? If you rewind, it's things I've highlighted as we've talked here, people, systems, processes, but I would really encourage founders and as companies evolve to not think about the IPO journey as just a check the box compliance exercise. If you want to get back to, hey, this is going to be a sustainable public company on a go forward basis. We're going to have great investors. We're going to have good interactions, on a quarterly basis. We're going to weather the storms of the market, right? And at some point, I once had, a founder that went public. He said to me, hey, I was so excited to get to the IPO. And then I realized it was like having the birth of my first kid, right? And you think about all the things in the future, right? That first birthday and graduation and driving a car and all these things. But at some point, if you don't have the operational discipline and you haven't laid out the strategy, right? It's really hard if you just treat it like a check the box exercise, right? So thinking about your control environment, thinking about the people that are on your team as you build out and grow and expand, as you embrace technology, as technology changes your business, how do you interact and face with your customers, your investors, right? Don't just check the box, right? Approach it as if, again, as you're thinking about it, hey, how am I going to make this successful on a go forward basis?
Excellent analogy. Didn't think we were going to go in the direction of birth of children, but you nailed it. Well done, Brian. Liana, let's go over to you. Bring us home. What is the one thing that you'd recommend all of the audience to think about and do starting tomorrow?
Yeah, so I think realistically, a lot of my companies have been 18 to 24 months to an IPO, for 5 months, 5 years now, right? And so, when I think about this in terms of where a management team should spend their time and attention and their money, right? What I would tell you is, what Brian said, right, is people, processes, systems, like get your operational pieces in shape, because that's good hygiene, whether you're public or whether you're a late stage private company that's just large and operating, right? And so I think there's a lot of focus areas within your operations where it's not wasted time, it's not wasted money. I don't want you drafting a business section. That will sit on the shelf, that will go stale. That's not a good use of time. But really focusing on building out the strength of the organization, and that's going to see you well, whether you're actually launching and looking at Q2 27 or that gets pushed further out.
Awesome. Thank you. And my big takeaway that you should all do tomorrow is hire every single person on this panel. They are wonderful and extremely talented. Hey, everyone, thank you so much for joining us today. I'm going to hand it over to Colin here. I think, Colin, you're going to run us through maybe some potential questions.
We ran out of time, but what a fruitful discussion. Sage advice across the board. So I think you nailed all the points that everyone was curious on anyways. In terms of analogies, there wasn't much space in there, Dan. Where were you? But
No, I don't. Well, for the record, by the way, Liana came in with a big goose egg in analogies and metaphors. I just, I was keeping track. Maybe next year, Liana, okay?
Amazing.
I'll work on that. I'll work, if you invite me back.
Amazing. Well, Dan, thank you for leading such a wonderful discussion. Liana, Liz, Brian, amazing job of covering all the bases and making it fun. Oh, see, I brought baseball back into it. But thank you all so much. And for our attendees, we're going to take a really brief break, but we're going to come back to our final panel of Life as a Public Company. Thanks again, everyone.
Great.
Thank you.
Bye.
Alrighty, welcome back. Hopefully that was enough time to get a refill on your coffee because this next panel is going to be packed with a lot of great stuff. So please join me in giving a special welcome to our final panel on post-IPO growth and compliance. In the panel, we've got Byron Laughlin, who's the global head of board advisory at the Nasdaq Center for Board or the Nasdaq Center for Board Excellence. We've got Erica Whitmore joining us again, managing partner at KPMG. Shannon DeLahey, who's a partner at Wilson Sonsini, and our esteemed moderator is Caroline Say, global technology executive and public company director. Welcome, everybody. Let's see, let's just start video. I think
Hello.
we're just getting Carolyn up. There she is. Hello.
Hi, everyone.
Hello.
Well, it's wonderful to have everyone on this call. I'm looking forward to having the panelists participate in this, and personally interested in learning from them as well. So as all of you may be looking forward to too. Maybe we'll just start off with a round of introductions. I know that Colin already gave a brief introduction of the roles, but if we could have Shannon, Erica, and Byron introduce yourselves, and one nugget, the single thing you wish every new public company knew on day one. We'll kick it off that way.
Great. Hi, everyone. I can start. I'm Shannon DeLahey. I'm a partner at Wilson Sonsini in our Palo Alto office. I focus on IPOs and sort of everything that comes after, so spend a lot of time with newly public companies, sort of 1 to 3 to 5 years out from IPO. It's wonderful to be here. One thing that I think every newly public company should know, it's not that bad, I think a lot of companies are sometimes nervous about going public, and I think the IPO process itself it's overwhelming and can take, like the better part of a year. That by the time you're through with that, I mean, life as a public company sort of just becomes pretty ordinary course. And there could be some growing pains in the first year, but especially working with the client base that I work with, in years 2 and 3, it sort of just becomes steady state. And most companies I know don't regret it. So that would be my advice.
Awesome. Shannon, can you hear me okay?
Yeah.
Yes.
Okay, awesome. Erica Whitmore, nice to see you all today. I'm with KPMG, and Shannon, I'm going to disagree with you a little bit on your comment, which I think will be good for our panel, and actually play a little bit on Brian Turner from the last panel as well. I would say for newly public companies, I think it depends on what kind of company you're going to be, right? So meaning what industry are you in, and are you going to do a lot of things, right? So similar to you, Shannon, I work with a lot of companies getting ready to go public, becoming a public company, and then kind of that, first, again, similar 3 to 5 years. And the companies that decide to do a lot of acquisitions or have a complete change in their strategy in the first 2 to 3 years, those are maybe a little bit more exciting, right? I think, maybe the steady state is also fun, Shannon, to your point, right? Like you kind of get used to being a public company, but I think if you're going to throw some of those wrenches in there, just be ready, right? Have the right people, which I think we'll talk a lot about on this panel with Carolyn and Byron as well. But that's what I'd say. So Shannon, sorry, just to throw a curveball there.
Yeah, no, of course. This is in the model where you go public and do a beat and raise every quarter for 5 years straight. So.
Yeah, that's right. There you go. That's the goal.
That's the goal.
Hi, folks. I'm glad to be here with Shannon and Caroline and Erica. My name is Byron Laughlin. I lead board advisory at Nasdaq. I am a 3-time entrepreneur with an exit to a public company each time. Telecommunications to AT&T, a development company to Berkshire Hathaway, and then the company that you will hear a little bit about is the Center for Board Excellence that is now the Nasdaq Center for Board Excellence. So obviously that was an exit to Nasdaq, but I continue here because I love corporate governance. And the thing that I would advise is about going public is if you get your organization right, meaning your structure, that what you don't want is surprises, have the right advisors or people that are advising that you have strong comfort in. The last panel will address that, and I'm sure Shannon and Erica and Caroline will help with this here. But I'm kind of in between Sharon and Erica. It can be great if the structure is early and done well.
Well, thank you so much, everyone. So Byron, I think that's a great segue into our first topic around good corporate governance before and immediately after the IPO related to board responsibilities. Especially in this environment, public market investors are underwriting a growth story, and the board's composition, skills, and operating cadence really need to evolve or support that. While also making sure that companies can pressure test that. Just love to understand from you, how should the board's composition, skills, and operating cadence look in this environment?
I'll jump in.
Yeah, we'll start with Byron.
I do a lot of this kind of work, public and private, and having a board, one that is able to be candid, open, honest, trustworthy, respectful, and that doesn't bring surprises to the table. I got you, I got a surprise for you, you're not doing this right. That's not what you want in a boardroom, be it a startup or a late stage large public company. Similar kinds of role all the way through. So starting out with a board, you want them to support you. There's a quotient between, or a balance between, confidence and accountability. They should always be bolstering your confidence while they are holding you accountable. And if the reason they're challenging assumption is to hold you accountable, respect that and take it. Pause, let things digest a bit. Don't be reactive.
I think that's really good advice, especially in this environment where things are changing. There's so much uncertainty, right?
Mm-hmm.
So to your point, I think it's incredibly important for the management to be very open, transparent, and to have that intellectual honesty, if you will. And many companies head into an IPO with a founder and VC board. What does a truly kind of public company ready board look like? And how much of it should be in place by the IPO or within the first 12 months of the IPO? And that's for Byron as a follow-on.
Oh, because I'm sure that Shannon and Erica can weigh in here too. I would get advice from someone who does some sort of CEO and board advisory work. One of the things about that I've noticed, I used to be a little bit down on coaching and things like that 20 years ago, and that was the dumbest thing I've ever done, is I should have had a coach years ago. And so coaching for both, there are the top board members and the top CEOs get coaching. Now, that can be very intentional by hiring someone, or it can be more nuanced by bringing in people like the others that you're meeting today in this entire IPO bootcamp. They're also coaching you in various key areas. But you want board members that aren't just celebrities. You don't want them because their name is going to help you bring money, although that may not hurt. But sit down and have a candid conversation with them too. Are they going to be strategic enough to bring you the advice rather than just, in a sense, window dressing to attract people into your shop? It needs to be more relevant than that. And most leaders should want to, anybody who has started and led something, they should want to have that input into your company, particularly as it's growing.
I'll maybe jump in with my 2 cents, and then I know Shannon's got some thoughts as well. I mean, you definitely want to have at least from an audit committee perspective, right? You want to have your independent members in, and that depends on which exchange you're on. But you want those in place well in advance, right? And I'll touch on this, and Brian might have touched on this on the last panel as well. But really being public company ready from board management, like the whole thing, right? And having practice even being a public company, I think is a best practice. But back to what Byron was saying, I think as far as your board goes, you really need to understand, what skill sets you need. And I think, Byron, you're right on with using a coach. I think that's extremely important. But then really making sure that those individuals are in place well in advance. And again, you've practiced those, on a quarterly basis, your cadence and kind of looking at the filings and going through the meetings, et cetera. In terms of like the audit committee, and I might be jumping ahead just a little bit here, Carolyn, but I do think that, having a high functioning audit committee, again, in plenty of time. So I'd say, and I'm conservative. I've seen plenty of IPOs. I've seen some go really well. I've seen some not go as well. The ones that have gone better have had those folks in place for a year, if not 18 months, right? And not only that, they have the background, right? This isn't their first rodeo. So I think that's super important. And then, just in terms of making sure that, back to what Byron was talking about, like having the right expertise, but I also think like that allows you to build relationships. And again, maybe there are already existing relationships, but there might not be, right? You might have identified some folks that, the CEO doesn't know personally, maybe knows a name and experience, but then that also gives the board and management time to develop those relationships, which are critical to the dynamic that Byron was talking about in terms of being able to be accountable, but yet supportive.
Yeah.
Yeah.
And Erica, I'm just kind of following what you're saying here in terms of the audit committee. Would you say there are other red flags in that an audit committee isn't really kind of in the best shape once you've gone IPO?
Yeah, I mean the biggest red flag. Sorry, I didn't mean to interrupt you. But I think the biggest red flag is when there's it's not tension, so there can be healthy tension, but when there's literally just disagreements, that's a big red flag. I mean, sometimes personalities just don't mesh. The other thing I would say is if you need to have a financial expert, right? That's required, right? But if at some point you realize maybe there's a missing skill set, so one thing that we've seen a lot more of lately, right, is cyber experience. So technology, cyber, really making sure that your board members are kind of on the front, the front end of like all of that's going on with AI. And again, that's a more comprehensive, everyone kind of needs to work together on that. It's not just on the board members, it's not just on management. But if you see that somebody on the board, really isn't up to speed on some of that, you never want your board to be comfortable. You want them to be learning all the time, right?
Absolutely. This is a good kind of topic related to audit as well as corporate governance or the nominating committee, just overall governance policies and the responsibilities for these committees. Shannon, would love to hear from you where you think disclosure controls, Section 16 filings, 10B, 5-1 plans, or anything, insider trading policies, anything along those lines that should be a part of kind of this minimum viable governance framework that companies should have kind of going into becoming public, and maybe what they need to really pay attention to in the first 12 to 24 months after doing so.
Sure. So I think, we kind of have our standard set of, call it 10 to 15 policies that companies should put in place as they're getting ready to go public. Some of them get more attention than others. The two areas that I think get the most attention are, one, what is each board committee going to be doing? To Erica's point, you likely will have had an audit committee, and the audit committee will have been functioning for, many months, if not quarters, if not years before the IPO. But that's not always the case with a comp committee or a nom-gov committee. So those committees are kind of getting up to speed as a newly public company and sometimes having their first, second, or third meetings. And so we typically advise companies to not get too adventurous in terms of what each of those committees will do right out of the gate, because there are things that the committees have to do, and then there are things that they could do, like should they have oversight over cyber or AI or ESG or all of these sort of buzzwords. A lot of those things can be kept at the board level, just at a high level, or you could delegate to a committee. And sometimes it's better to just let that play out in the first, year or so to figure out which committee is handling those things before you formally bake it into a committee's charter, because a lot of times as a newly public company, it's hard enough just to get the basic things done, let alone adding in all of that other stuff. And so that's one piece of advice we've been giving public companies lately. And they don't always follow it. Some committees feel really strong that they want to handle cyber, or, ESG is very important to them, so they want to handle that at the nom-gov committee level. The other area is everything about how people will be able to trade their stock, right? One of the benefits of going public, now you have a liquid market. So insider trading policies, the use of 10b5-1 plans, information restriction within the organization, blackout periods, the Section 16 filings for executives, that's all very hot topics. I know we might get into some of that later on, but some of the most classic design choices we get asked are, will the entire company be blacked out during quarterly blackout periods post-public? And we typically advise yes, because most companies have a very hard time restricting information sharing across the organization, right? You have people that have access to Salesforce, or you're used to doing like big all hands meetings where everyone gets information, and that cultural shift is sort of hard to cut off information access, and you have to really think now about the timing for all of that. Like, yes, you can still have a town hall to release your information, but you have to do it sort of simultaneous with when the market is getting it as well, so that your employees don't have information ahead of the market. So we spent a lot of time thinking about, and what's the right length for a blackout period? How many weeks out of each quarter can employees trade? So all of that, the right list of population for folks that can go onto 10b5-1 plans. There's a real tension between, it's of course protective, and a lot of people want those, but how deep into the organization should you go? Because then the legal team might have to manage, hundreds of 10b5-1 plans for, folks that want that protection. So that's always a topic of conversation. Yeah, I think those are the key points to note.
And when it comes, Shannon, to just independence requirements or related party transactions, staggered boards, just anything that might be a little more unique to governance choices that founders try to adopt, what would you say they often regret maybe 6 to 12 months after an IPO? Is there anything that they wish they really could change? And I'm sure the proxy advisory firms come in and weigh in so much that they're paying attention.
Yeah. Well, we do a lot of work with founder-led companies and a lot of dual and multi-class structures. I think a few things to note. One, it's actually very hard to change those structures after you go public. The stock exchanges have rules that basically prevent you from, like, if you have a high vote stock and you say, okay, this high vote stock it'll vote 20-1 compared to, you can't just like decide to change it, say, oh, it's going to be 30-1 or 40-1, even with a stockholder vote, which is very hard to wrap your head around, that there's something sort of in corporate law that even if you got all of your stockholders to agree that you want to change it, the stock exchanges just say fundamentally the structure that you go public with sort of is your structure, and you can make modifications around the margins, but you can't sort of fundamentally change the capital structure of your company. So founders spend a lot of time upfront thinking about the design of that, because it's very hard, if not impossible in some regards, to change it later. So that's one piece of advice that we always give founders, like we have to take this really seriously. And other things you can change. I mean, the other big piece of advice is go out with the most protections if you're a founder-led company that you can put into place, and there's sort of the standard suite of documents. That way, if activists or proxy advisory firms are sort of coming after you later, you have bargaining chips, so you can always say, okay, like, we'll eliminate our classified board, or okay, we'll switch to majority voting for directors. Like, there are things that you can give down the road as you become more mature.
Let's go back to director composition and skills. Byron, love to hear from you what you think director onboarding and ongoing education should look like.
Sure.
Versus just a checkbox, which I've experienced with some of my boards, but I've seen best in class too. So I'd love to hear from you on that.
Sure. And first and foremost, you want cognitive diversity that can help you think around your strategy and pressure test your strategy, and those that they'll push it, but they're not going to get into being the managers. And as the CEO and the management team, before and after, you want to become very familiar with the process of balance between board and management and where it should be pushed. So in other words, the board should be pushing up against that management balance, but not stepping in and playing at times a temporary management role. That the problem I see sometimes there is particularly with younger companies that are headed towards IPO is if the board is a lot of PE, they become a little dependent on some of that. They want to back off that dependency and imagine that you're standing alone and the board is advising you, not that the board is advising you and you're only standing together. You've got to be able to also, because probably 80% of the time you're making decisions as a manager or as a CEO on the fly. If you're inside the thresholds of what's been set for the company, you've got to make decisions that could be challenges to the board. So the composition, also having a broad understanding of your product and adjacencies, is where I've seen increased benefit. Traditionally, boards tended towards having a lot of financial expertise, but not as much in areas like culture and CHRO or people. These areas have become beneficial because they help the CEO think about things that aren't necessarily directly in front of him or her, and that includes managers too. And so diversity of board, meaning cognitive diversity that's bringing different thinking, looking down the road and around the corner at what could happen, and then a sufficient expertise generally in board and business matters, but some layer of direct or specific expertise. I am seeing a lot of a lot of boards searching for and bringing on somebody that has good business knowledge, but also some layer of AI expertise to help understand where could this take us. That's one of the key questions: is how can this board member add value through what they're able to provide as feedback in that pushing the flywheel ahead.
Right. Absolutely. Let's get into more of the kind of operational details, if you will, around internal controls, readiness, risk management, or compliance. I'll throw this out to the entire panel. Feel free to chime in on this one, any one of you. In one word, what would you say changes the most after the bell rings, and why is that most leadership under teams underestimate?
Well, I'll yell accountability, and then I'll let Shannon and Erica respond.
Shannon, I can go because it's actually similar, Byron. The word that came to mind, Carolyn, when you said that was pressure, right? I think that's just the reality.
Yeah. Okay, great.
And the result of those two things, accountability and pressure, is like the never-ending threat of litigation over having the stock
Fair,
drop.
Shannon.
I think the constant sort of obsession with the stock price is an interesting, just like emotional, mental thing that happens, because you have this like daily measure of how you think your business is doing or how others view your business is doing. So I mean, I will say that like if you have a bad earnings and your stock goes down, I mean, you're sort of worried about that class action lawsuit hitting. So that's why, of course, focus on disclosures and good disclosures and all of that is super important. Yeah.
And Carolyn, I do want to emphasize that having two people like Shannon and Erica in your corner tightly, because you're going to need legal advice fast, and you're going to need a range of financial advice fast that possibly board members can't assist, but they can't assist to the extent you may need. So having folks like this, because you have to be very careful who's on your board before and after. Going back to that reliance element I talked about, a lot of people try to get lawyers on their startup boards to get free advice. You can't do that anymore. After you're going public, you need to be authentic in all that you do. That's one of the other outstanding words that CEOs particularly should think about.
Yeah, absolutely. On internal controls, so want to dig in a little bit on that topic. Erica, I think maybe we'll start with you. SOX is where many new public companies might stumble. Walk us through the runway from 404A to 404B and that status and where the real internal controls work happens.
Yeah.
And feel free to bring up anything related to weaknesses, restatements, and deficiencies and what happened.
All the fun stuff, Carolyn. Yeah. I get the fun stuff. Shannon, you do too. I mean, really 404A, the difference between 404A and 404B, right, is one is management's assessment, which is required 1 year after you go public, right? And 404B is your auditor giving an opinion, right, of your internal control environment and its effectiveness. And when you are required to have 404B depends on if you're an emerging growth company, right, and what size your company is. So there's some rules around that. You can look them up. AI is good for that, right? But I think, you know, where we've seen companies trip up, and I'm going to be repeating myself a lot, right? The earlier you get ready, the better. And so I would strongly recommend, and again, Brian probably recommended this on the last panel as well. If I were a CFO for a company that was getting ready to go public, I would do an IPO readiness assessment, and I would do an internal controls readiness assessment. And I would make sure that your IT environment, your vendors, your operations, like soup to nuts, right? You have that all covered, because that gives you a roadmap of here's where we are today and here's where we need to be as a public company. So that's just more of a, hey, make sure that you do this, right? I think it's very, very important, because to your question, Carolyn, where we see a lot of material weaknesses, where we see companies trip up a lot is your general IT controls, so your IT environment. And now with AI, that is adding a new, very, very complicated layer, right, to this whole thing. So again, just more important, right? It's even more important. I would say segregation of duties, right? If you're a smaller public company, or you're a smaller private company, sorry, looking to go public, you might not have quite the resources. So again, just getting in there, really making sure you have segregation of duties. And then a couple of accounting areas that are just, you know, there's often material weaknesses or significant deficiencies related to is revenue recognition and stock compensation, right? But if you've planned ahead, right, you have all the years audited that you need, all of your quarterly reviews done, heading into the IPO, you've had that internal controls assessment, and you've had it early enough to identify. I mean, as a board member, I'm like, I want to know about all the skeletons. I want to know about every single one of them, right? Let's get them out there and let's fix them, right? And then make sure that the company has the resources and the expertise it needs to get everything fixed, right? And I think Byron said this, and maybe even Shannon. I think, you know, from a board perspective, being supportive, again, you have to hold management accountable, but I think not the gotcha, right? Just like you don't want your auditor to have gotcha, which I would not. I mean, that would be terrible, right? You also don't want that from your board. You want support. Again, it doesn't mean that you don't have to do all the right things you do, but the board can be supportive in making sure that management has the resources to get it done, and get it done right, and get it done in a timely manner. Sorry, Carolyn, I really
No, that's great. I touched on a lot of different areas. A lot of accountability, building trust. That has to do with the relationship between the CEO, who may or may not be the founder, and the board. I'll just toss this out to all of you, but Shannon, I'd love to start with you. Just how does the relationship between the CEO and the board need to evolve? And what role should the lead independent director, if there is one, or non-exec chair or exec chair, play in that?
Post-public. I mean, I think the role of the board vis-a-vis the CEO is sort of the same. I mean, it doesn't change that drastically, but the lead independent director is interesting. And that's, not all companies need a lead independent director, but a lot of times if your CEO is also the chairman, then it's recommended that you have a lead independent director. So I do see a lot of lead independent directors sort of trying to steer the agenda, getting input from the other board members, and trying to make sure that those issues are addressed at upcoming board meetings, as opposed to the CEO and the management team sort of dictating the agendas. I think that's sort of the most important role, is that agenda setting power, right? Because if you carve out time in the boardroom to tackle something, then it'll be addressed. I don't know. Byron, do you want to weigh in? I'm sure you have more thoughts here.
Well, that area, what I find is it goes from being a partner to more of a fiduciary and accountability role, and understanding that there lots of times CEOs can, when I do interviews with CEOs separately and board members separately, I can find that this subtle division can form, but it doesn't need to, because the shift is from sponsorship, kind of being in it with you, to more of stewardship. And the stewardship, the being 100% owner, let's say, or some large percentage before, the board had to serve you. Now, let's say you've sold off more than 50%. Now the board definitely has to serve the shareholder also. Now, what's good for you should be good for what's for the shareholder, we would hope. But that's a significant difference. If it's no longer good for the shareholder, they have to make a decision whether or not you should stay or not. And you should be a part of helping make that decision prudently, not holding on at all costs, using that as just an example of the kind of stewardship that they have to carry. On the other hand, being devoted to the stewardship side of it and gaining independence or maintaining a high level of independence isn't disloyalty either. So as a CEO, if you start feeling like somebody's disloyal, have a gut check of whether or not you feel like they're doing their job better, given their new role, or a role that they are developing into in your company, now that it's the public company, or are they actually being disloyal? Because that's one that becomes very troublesome quickly. And it can, companies can perform well. This is the sad part about the nasty side of our job is meeting, or the less enjoyable side is meeting CEOs that feel isolated, lonely, and frustrated because their board has turned a way that they didn't think it would go. Mm-hmm. And so being proactive about these things, that's one of the aspects I hope you get out of this, is to develop these relationships authentically. And that's where a third party kind of coach can help out of some sort, can help you maintain that integrity of relationship and drawing clear lines of what's the difference between stewardship and disloyalty.
And Erica, I think along the same lines, when you think about a broader shareholder base, maybe you have other stakeholders now involved, what does the finance function need to look like in the first 90 days to be able to be credible to the street and build confidence among shareholders?
Yeah, no, Carolyn, thank you for that. And actually, that brings me back to the last question you asked as well. One of the things I failed to mention was that often companies have a material weakness related to is a lack of resources or a lack of resources with the right skill set. So to your point, right, I think having, a CFO, potentially a CAO, depending on how big or complicated the company is, right? And then the appropriate accounting managers, VP of finance below that, I think, and we haven't gotten into this really, but I think, whether or not the company is going to provide some level of guidance, I think most companies do, right? I think depending on if you're a tech company or I think it's the S&P 500, I think it's well over 50%. I think it's around 60% provide forward-looking guidance, right? So if you think about all the things that you have to do, yes, your systems can do a lot of it, but you have to have the folks in place that know your business, know how to tell the story. You need all of that in place, and you really need it in place before the IPO, right? Again, back to what we talked about earlier, having practiced it, right? They need to really understand, again, not just how to tell the story, but get the books closed, know how to put those forecasts together. All of that is super important in terms of like building investor confidence, right? And I think that's regardless of what kind of shareholders you have and regardless of how much of your company is sold. I mean, even controlled companies, right? They have a public float and they have a responsibility to those shareholders to make sure that what they're presenting is appropriate and that what they are forecasting in terms of revenue or margin, if they are, is they can be relied on because, and I'm foreshadowing a little bit, but because if you lose that investor confidence, that just sucks, right? And Shannon can speak to what comes over on the legal side, which you just want to avoid.
Yeah. And that's a good segue to, engagement, communication with your shareholders. And I've seen different ways of doing this. Morningstar, which was a founder-led company, the exec chairman is still involved, who's the founder, and they hold annual meetings in person, whereas a number of my other companies have gone to remote. But they don't issue guidance. They don't hold quarterly earnings calls. And so it's a bit unusual. They started off that way and always have held to it. But love to hear from you, Shannon, how companies should approach shareholder engagement proactively.
Yeah. I think it sort of depends on the company structure, because all of the investors, I mean, there's sort of the investment side and then there's the governance side. And there's certainly a lot of companies that we work with that are founder-led that have very protective structures that say, you know what, we're not really going to engage on the governance side of things because those are not they do not make the investment decisions usually. So like if you have a proxy proposal and you're asking them to vote on a governance proposal, they would weigh in, but they're not like the actual buying and selling. So there are some companies that just say, we're not going to engage with them because we know what they're going to say, like eliminate the classified board, get rid of your dual class structure. We don't want to do any of that. So like I've seen engagement on that front be zero. But then as you're a more mature public company, as if you don't have those protections, if you're not a founder-led company and you just have like one class of stock held by public stockholders, you do tend to get a lot of pressure. And you see through the shareholder proposal process that concessions start to be made along the way. And so by the time, you're 20 years down the road, I mean, you've kind of given away a lot of the sort of anti-takeover protections. That's on the governance side. I think that that's less important than just like the pure investor side. How do you engage with your investors? I mean, most companies have, strategy that they're going out to talk to at least like the top 5, top 10 investors every quarter. Might be doing it on callbacks just to kind of hear from those investors, hear what's on their mind. So we certainly have examples of that, and investors raising all kinds of issues, right? Like, you're going to do a stock buyback now, or are you going to do this? I mean, it's good to engage with those investors and potential activist investors early to see if you can have dialogue with them before all of a sudden they just mount an activist campaign against you. So, I mean, that sort of shareholder engagement is the number one thing that you can do to sort of ward off activists and just keep your investors happy.
So easy, right, Shannon?
Right.
Just keep them happy.
Just to pile on to that, quarter misses or changing expectations and market conditions constantly shifting. Like, how do you reset expectations or set expectations without destroying trust? And this is a question I think so many companies, or all companies, are grappling with. Would love to hear from any of you who want to pitch in on this one.
I can start. I'll just speak to what I've seen. A few of the CEOs that I've worked with on new public companies, things happen, right, Caroline? I mean, there's changes in the macroeconomics, there's changes in industries, especially right now with AI. But the CEOs that I've seen kind of navigate that very well, even if there is a missed quarter or frankly several missed quarters, right? Maybe there's a change in strategy. They are not as focused on the daily stock price, right? They are focused on their North Star, whatever that is, right? Their strategy and telling the story. They do have to tell the story, again, going back to keeping the investors happy, right? But then also having those one-on-one investor calls with some of maybe their bigger shareholders, et cetera, so that, again, they're not sharing things that isn't public, that are, it's not public, but just reiterating that story, right? And here's the plan, and here's when you are going to see results, et cetera, but not focusing on the daily stock price or maybe even the quarterly, depending on the change in strategy and how long they need to execute on that.
Right.
Yeah. I think good disclosure too is a way to solve for this. I've seen, in helping companies through numerous earnings cycles and sitting in board meetings, as a lawyer, I can hear like sort of what's going on. And then sometimes when I get the earnings materials, I think, wow, what a great explanation of every driver and exactly what's happening in the business. And I think that those companies get a lot of credibility, even if it doesn't really, your stock price might still fall. If you miss your guidance, you can't really solve for that, but you can buy credibility with your analysts so that when you're on the upward swing, right, then they believe you and you're just very forthcoming in your disclosure. And I've seen other earnings materials that just, I don't know, they tend to like, it's so high level that you can't really understand what they're saying, or it's like, okay, well, what really happened? And I think that it's not the best approach.
And building trust is an active behavior. And it's not, they kind of fake it till you make it type of thinking. And a part of that is this old-fashioned concept of being a plain dealer or plain dealing. I think it was a legal term at some point, maybe. And that's that you're going to tell it like it is. Now, you want to tell the story honestly, with integrity and crispness. I wouldn't try to sugarcoat it, but tell it well. What happened? Why did it happen? And how are you taking corrective action to fix it? Was it a marketplace change, or was there a mistake that in investment or allocation of resources somewhere that you've corrected and you're seeing trends? They're going to be following the KPIs that monitor this closely. If you tell a good story, an accurate, crisp story, and they see the KPIs following, they're going to start to trust you more and more over time.
That's great. So I am going to go to this last section here, which will be a fun section before we transition to Q&A, and maybe we'll do this more rapid fire, but I'll throw this out to the entire panel. What surprised your clients most during the first year as a public company?
How fickle the investment community is often comes up.
Byron, you and I are on the same page. I was going to, he took mine. I think just how, yeah, no, I think that's true, right? I think, and being out in the public eye it can be brutal.
I have the same reaction. I've heard like plenty of CEOs tell stories of like, their friends and family were invested in the company, and all of a sudden they're getting calls from their uncle, like, what's going on over there? Stock prices way down. And I think that it's just like an emotional toll that you have to just, I like what you said, Erica, like stick to your North Star, just like keep marching ahead, try not to let the noise factor in. I mean, it's also hard if it was due to company performance, right? It's very easy if it's like, well, look at what's happening with SaaS stocks now or something. But if it is like, well, yeah, it was a bad quarter and we missed, don't worry, we'll turn it around. I mean, it's really hard. And you have employee morale. I mean, you have people's net worth tied up in stock of your company. And it's really hard if you're having a difficult stock price performance period to weather that storm.
Yeah, absolutely. And what is the most common mistake that you think new public companies make that could have been prevented from the IPO? Or another way to frame this is, what's the comment that you hear the most often around, I wish we'd done this pre-IPO?
I think what I hear a lot is, there's a lot of talented individuals out there with very, very great experience, right? But I think, and those who know me, this won't be any surprise. But if it's not a good culture fit, it's not a good culture fit. And I think making sure you hire not only for talent and what what resources you need, but also somebody who's really going to fit well in your culture is critical.
Yeah, I've seen that happen in the boardroom, especially because to our earlier discussion, there are all these rules, stock exchange rules of what you need on the board and for each committee, and there are phase-in rules so you can do various things up to a year after going public, but really nobody relies on those. Some companies do, but I think like the gold standard is to say a day one, like, look, we're a public company ready, we have our board completely intact, but the reality is that folks are scrambling to get their board. Sometimes like new board members join just months before the IPO, and then in the first year of going public, which can be a challenging time anyway, you're sort of dealing with a whole new cast of characters. And, I hear a lot within the first year of going public, like, oh, this board dynamic isn't quite working out. And there's sort of regrets on that front. So maybe it's better in that case to go public with a smaller board. I've seen that more and more companies asking, like, how many directors do we need? Do we have to have 8? Could it be 6? Could it be 5? And I think if you have the right chemistry and mix of folks, and it's only a 6-person board, like you can do that. It just might mean that your directors have to do double duty on certain committees, and it could be a heavier lift for them, but maybe that's worth it as opposed to trying to rush out and expand your board.
And I have a few fundamental rules that help guide what Erica and Sharon are talking about. One, surprise is an enemy. They're going to
Yeah.
get you if you bring and some good surprises. Be careful. Structure is your friend. And in that structure, think of it as governance is strategic and expect an ROI on your governance. Governance is highly relational, and don't alienate your allies. And those allies can be a wide range of people that should be your friends or your confidential folks that are challenging your assumptions, both inside shareholders and board members and outside counselors.
We'll leave on that note. Thank you so much, Erica, Shannon, and Byron. I'll hand it over to Colin to see if we've got any time for questions.
Amazing. Well, we do have some time for questions, but Caroline, thank you so much for leading such a wonderful discussion. And Byron, Erica, Shannon, so many awesome stories and lessons learned. There's a lot of great stuff. So if you haven't dropped your questions into the Q&A box and you have one, please do so now, but we've got some ready to go here. And I'm gonna start us off with an interesting one that came in. So, how do you align and protect a company's values and mission as a public company?
I can start with that. I think we get this question so often because what we hear is like, we're an open, transparent culture. We tell our employees everything. We want to incentivize them to keep working hard in the business. And you're telling me that when we go public, basically we have to keep our mouth shut on all of these types of things. And I think it's a real source of tension because founders and management teams think that they need to run the business in an entirely different way. And to some extent that's true, but just going back to what I was saying, you can still have all of the same, rah-rah town hall and sharing of information. You just have to make sure that you're doing it at the same time you're sharing it with your investing public. So I think sometimes it's just changing the timing for that. Like, hey, why don't you hold that town hall to discuss your quarter right after your earnings call? Can you do that as opposed to like a week before? So some of it is just timing. But there are some things that, if you're in talks to, have on a major M&A deal or something, you're going to need to keep a very tight circle of folks in the know. And I think that you can sort of rationalize it by thinking about the fact that the more everyone knows, the less time they'll have to trade their shares, which is probably what they not ultimately care about, but it's a big piece of it. So there's a real trade-off. If you have all of your employees always in the know on things, then they're not really able to, monetize the compensation that they're getting, usually in the form of stock awards. So I think that it's good for the employees to sort of keep that information circle restricted.
Thank you, Shannon. Byron, anything to add there, Erica, Caroline?
One thing I would emphasize is Sam Walton's right-hand person was a close friend of mine back in the early days. And frankly, I still see a lot of Sam Walton hanging around. And you even see them reinventing themselves. And, they've had high times and low times, but they've, like any company, but it's interesting so I think the fundamental values that are put forward somehow, that structure is your friend kind of concept, maintain them structurally like you would want to build a well-built home or building, and think of it that way.
Yeah, I think to follow on to that, I'm seeing more of the CEOs I work with being more hands-on, especially in this environment, and having to be the stewards of the culture, right? The values and the messaging, and not just leave that up to management, however much they trust their leadership. So I think having that structure, having that stewardship is important.
Another question here. I'm going to do a book plug, Byron, but other than your book, any suggestions for the panel from the panelists on a good book to think about the zero to IPO public company process, we hosted Freddie Crest for his book on zero to IPO, which is good for the early stage, but any other good governance books, any public company books?
Couple that I think are essential is Cynthia Montgomery's books, The Strategist. That's one of the best books I ever read. And then Good to Great kind of changed my life back in 2005. And
I second that,
so
Byron.
those are two.
The other one I had was The Hard Thing About Hard Things from Ben Horowitz. That one's a good one, but agree, Byron, on good to great.
I liked that book on Boeing and sort of the board oversight issues due to the 737 MAX. So that was an interesting book, I thought, just from a governance perspective, and got into all kinds of like legal things that I think about all the time, like stock buyback programs and things like that. So that's kind of an interesting book to read.
There's
I have
a new
one. Oh, go ahead, Caroline. I'm sorry.
Oh, no, I was just going to say there's a new one I haven't read yet, but it's Eric Ries's Incorruptible, Why Good Companies Go Bad. And I think that might be a good one in these times. And I'm looking forward to getting a copy. I think it just got released this week.
A little different one, if somebody wants it, is Danny Meyer's book, Setting the Table. It actually has a lot to do with what we're talking about. It's more subtle in its substance, but very strong in its cultural implications and how to grow your presence in an authentic and beneficial way among your employees.
All great recommendations. I own half of them, and Caroline, I even heard about the new one, so I got to add it to my Amazon list. In addition to Byron's,
which is new.
Yeah, well, it's hot off the press. And also, yeah, Billion Dollar Coach. I've been recommended to, but I haven't gotten to yet. Alrighty, this one is a little interesting, but curious on your thoughts. Is there a good time of year to take your company public?
I think the spring or the fall. It's really hard to go public at the beginning of the year because you're trying to get your audited financials done and all of that. So kind of the classic windows are like, April, May, and then so you can do it in the summer, but then like August is, sometimes you see banker calendars and August is like all shaded out.
It's
like
always shaded out, Shannon.
Shaded
They are
out,
gone in August.
And then right after Labor Day through Thanksgiving is always like good times, and then sort of after Thanksgiving, it's like, so, probably I think the most common target is always September through Thanksgiving. And then if you can't hit that, it's like, well, let's do April, May of next year.
Yeah. Yep.
People take vacations. What do you know? Even entrepreneurs.
I don't think it's the entrepreneurs, to be fair. She said bankers.
That's true.
Yeah.
Let's see. Are there incentives/advantages for companies that have a significant positive impact, like biodiversity, resource consumption, health, etc.?
You definitely want to leverage that and know your shareholders and get in touch with your shareholders earlier. And what are you doing differently and why should they invest?
And I would say, and I'd love others' thoughts. This is just Erica Whitmore's view of the world, but the retail investor is very, very important. And depending on, the company, right, you might have a fair amount of retail investors. And I think making sure that you are communicating effectively with them is super important.
That's good advice. Caroline, since you did such a good job moderating, but you're also founder and public company board member, what advice do you wish you knew as a founder and then learning through being a board member for public companies do you have for our entrepreneurs?
Yeah, I think one of the most complex situations to be in is your stakeholder base just grows exponentially. And so how do you stay clear as a public company CEO or part of the management team in setting priorities and managing all of that? right? I think it took seeing that from my public companies, especially the Coca-Cola company with the scale and the number of markets it does business in, where the CEO is expected to be in 3 different countries across the world at the same exact time, right? So how do you manage through that? How do you set up your leadership team so that you can be in multiple places at one time, interfacing and communicating with investors? So I think that complexity just grows from running your own company in a private situation to becoming public.
Great advice. Byron, you look like you want to add on to that because you've also been in that scenario.
Well, I circling back to the co-author on CEO Ready is Mark Thompson, who's one of the more influential coaches in the world. And he cut his teeth by being the leader under Chuck Schwab to create Schwab.com. And gee, I wish I'd met him about 4 or 5 years after he had done that. His advice has been, and finding someone like that, that was something I didn't have. When I started Select Homes back in the early 90s, it was a tough road to, I get advice from people, but they were usually friends and not experienced at seeing a company grow quickly and all the pressures that occur when things start to take off.
That's great advice. Another question here. What are the specific requirements for board members, like certifications, or their citizenship clauses? Do they have to be American?
No.
Oh, I didn't know that yet.
There aren't really certifications. The only real certification is your audit committee financial expert, as Erica discussed. That you really do have to have some real experience. But for every other position, not really.
It's not a certification, but you do have to have authentic independence, for example, on compensation.
Yeah.
Well, and I think that there's, I think Nasdaq has a board center and KPMG has a board leadership center, and the National Association of Corporate Directors. So I do think, even though, like everyone said, it's not necessarily required, most of the board members I interact with, they're doing continuing education. They're learning about, they're interacting with a lot of different board members, either in their day-to-day life or through one of those other avenues, which I think is super important.
Yeah.
And that is a big change in the last 2 or 3 years. Board chairs and CEOs and large and small public companies are starting to say, if you're not active in your education as a board member, your days are numbered.
Solid advice. I've been to some NACD events, and they're very educational. So,
yeah, I recommend joining NACD, or depending on where you are in your life cycle, the Society for Corporate Governance. That leans a little more towards corporate secretaries, but not exclusively. It's also a good place. And frankly, just the documentation that you get, the blue ribbon commissions and these things at NACD and similar at the society, it's worth the admission price.
Totally. It's a great room to network into, in my experience. Any advice on, and this is to whoever wants to jump on it, any advice on continuing momentum post-listing, growth, and relations?
It's kind of like Nike.
Just do it.
Just do it.
That's what came to my mind. And run faster.
And don't check the stock price.
Yeah, by the minute.
Yeah.
Steer towards, every few days, maybe.
Well, we're out of Q&A, but what a lovely discussion. In order to wrap us up in a golden nugget fashion, I'd love to go around the room and just one key takeaway from this topic in this panel that each of you want everyone to go away with today. So Erica, I'll start with you, Shannon, Byron, and then Caroline, you'll help us land the plane.
this isn't going to be a surprise, but get ready early. That's my advice.
Good advice.
And hire the right people, both internally and externally, especially like some of the key technical areas too, like legal and technical accounting. I see companies sometimes struggling in that area, even post IPO. So it's good to get that team in place prior to the IPO.
Great
Well,
advice,
and a lot
Byron.
of good things have been mentioned. And so I'm going to apply it to one other thing that we didn't really talk about, but it's not the goal exactly of this. And that is the difference between AI and AI, artificial intelligence and artificial ignorance. And as a board member or leader, follow the pattern, develop your pattern recognition around errors. Just like it used to be financial errors, now it's AI errors, and they will have financial implications. So that's another area. And boards should expect AI intelligence reporting around the errors that are occurring so they can be fixed at a positive rate.
Great advice.
All good points. I think the only thing I'd add is IPO isn't the success or finish line. It's all eyes on you. So more transparency, more accountability, and more intellectual honesty.
Amen.
Amazing. Well, what a way to end our IPO Bootcamp. Caroline, thank you so much for leading the discussion. Byron, thanks for joining. Erica, it's great to see you as always on these, and Shannon, you too as well. Thank you all so much for joining us.
Thank you.
so
Thanks,
much.
everyone.
Thank you.
Amazing. Well, 4 action-packed hours later, we're here at the end of our IPO Bootcamp. Thank you everyone for attending, and we hope you found value in learning about all of the nuts and bolts on taking a public company in this exit pathway. We'd love for you to join our upcoming webinars so you can view them in the links that we're going to be sharing in the chat. Also, we're going to be following with more information, details, resources on all of our programs that we have coming up. But thank you all for joining us, and we look forward to welcoming you all back online soon. Thanks again, everyone.